Thank you. What an inspirational speech from Her Majesty Queen Maxima. We will now have a fireside chat on technological innovations and central banks exploring new horizons. But before we start the discussion, we regret that Jemima Kelly, who was going to moderate this session, is unable to attend. But now please welcome on stage the head of the BIS Innovation Hub, Cecilia Kingsley, and Per von Zelowitz, the director of the New York Innovation Center at the Federal Reserve Bank of New York, who will moderate this discussion. The floor is yours.
Cecilia, we're delighted to have the opportunity to speak with you today about drivers of central bank technical innovation, lessons learned from the BIS Innovation Hub, and the future of central bank innovation labs. An increasing number of central banks are engaged in theoretical research and practical experimentation with innovative technologies relevant for the financial industry. And I wonder if you see this as a passing fad, or is this a permanent trend?
Well, thank you first, Per, for sharing the stage with me. It would have been a bit lonely if I had been the only one. Jemima couldn't make it. So we are innovative also how we work at the Hub, and thank you for stepping in on short notice. Is this a passing fad, you ask? No, I don't think so. The central banks, in essence, needs to understand what's going on in our economies, our societies, and not only the cyclical aspects or the changes for meeting the monetary policy objectives and the financial stability objectives, but also understand the more structural changes. And if we take the broader perspective, the globalization has been a tremendous force of change for decades. But we've also had strong changes that has been much faster, such as the pandemic. And I dare to say that I think the digitalization and the forces is both very strong, very changing how we live our lives, and it's going to be with us for a very long time. So in order for central banks to basically stay relevant and be able to provide their role in society in the best possible way, just doing academic research, which central banks are very, very good at, is no longer enough. You also have to understand the tech world and be prepared to experiment. And I think about it from two perspectives. One is to do projects that is making it possible for the community to understand what's going on out there and how that will affect the financial systems and therefore how it affects our ability to do our jobs. But also kind of look inside ourselves and scrutinize the central banking community in the way that how can we use these technological changes to actually do a better job. And I think the 6 focus areas that we're working along is kind of pinpointing exactly that, so we can do improvements in the current way of working, like in subtech, but we can also, and we are also doing groundbreaking work in things that hasn't not yet been done, such as new financial market infrastructures.
That's great, and I love how you compare the external focus also with the internal focus. I think that's a fantastic perspective for us to have. And it's been an extremely busy and exciting 3 years since the BIS Innovation Hub launched. And I'll start with just a few numbers. There are now 5 centers globally with more to come. There are over 20 projects that have either been conducted or are currently in flight within 6 focus areas, all driven by a team a diverse team that is over 60 people at this point in time. And to provide a reference point relative to the start of the BIS Innovation Hub to where we are today, Meta, formerly known as Facebook, started Libra, formerly known as DM, around the same time that the BIS Innovation Hub launched. DM is no longer here. The BIS Innovation Hub is certainly still here. And I wonder if you could talk a little bit about, is there the same sense of urgency and need to the BIS Innovation Hub today as there was when it launched? What has changed, and what are some of the lessons learned from the start until today?
Well, first, an interesting way to frame the origins of the hub. I think it's fair to say that when the idea first came up, it sort of grew from many different aspects. But I think certainly the Facebook-led initiative was a wake-up call, a reminder for some that there is a lot of initiatives going on around in the world, which are exciting and good, but also can change the world of central banks and financial supervisory activities in a very profound ways. And it's bad to be surprised in that angle. So the reason why we're having such an ambitious scope is that it's a necessity, basically. From the 6 focus areas, it's I think about the project portfolio as coming from Sweden. So I would like to do the analogy of a smorgasbord, which is having contributions in the focus areas, and that is about, from some extent, improving what we're already doing. But it can also be completely new things. And then it's up to the central bank governors, which is our nearest bosses, but in essence, up to each and every country and their legislators and their executive powers to think about, okay, this is what the BIS Innovation Hub, and for that matter, other similar operations, showcasing what could be done. But then it's up to each and every country to decide on what is appropriate, what should be done, and that is kind of above our pay grades to decide. But let me be a little bit more concrete. You will hear more about Rio at this conference, and Rio is a really great example of taking that the world is changing and what can we do to be better at our job as central banks. When I came to the financial markets in the 90s, market makers were real people, and they were with real phones in their hands. And if you wanted to know, as a central bank, well, how's the liquidity, how's the prices, what's the order depth, you spoke with these people, the market makers. And to simplify it a little bit, but now there are more computers talking to one another, and who are you going to call in such an environment? And Rio is the answer to that. It's a software intelligence tool that monitor the FX market, the liquidity, and the order depth, and etc. And it's exactly what we need in this new brave future. And the other thing is building completely new things. I personally like Rio, the fast payment operational system that will make it possible, hopefully, to connect the 60 plus and growing number of fast payment systems in the world. And we're also looking into novel technologies, such as in Enbridge, which is covering wholesale CBDC. It remains to be seen which will see the real light of day. But we are here to help and to provide good proposals for others to bring on and forward.
That's great, and certainly I can feel the sense of urgency is still here and increasing over time. And the BIS Innovation Hub really plays a central and critical role to figuring out this increasingly complex world that we have. And speaking of increasing complexity, and I know it's always dangerous to polish off the crystal ball, but I wonder if we can talk about the future a little bit now and what the future might look like. And considering the BIS Innovation Hub's current work program, and then how that might evolve over time, I wonder if you could speak a bit about what your vision really for the future of the BIS Innovation Hub is, how its role might evolve over time, and really the critical value that you see it delivering going forward.
Okay, so first I would say regarding the 6 focus areas, I think they are the relevant ones now. But we should be prepared to make a revision, to add or take away some going forward. That is how you stay relevant. Second, I would say that we are now landing our projects in what we call the proof of concept and the prototype space. And that is I would say, a good place to be in, but I could also call it a good start. If we look forward, the way we are thinking about it at the Innovation Hub is that if others wants to take our findings, and they are there in a transparent way, and bring them forward, and even bring them forward to a real-life setting, to a launch, under certain conditions, we are happy to assist during that journey. And speaking about that journey, I think there's also room for improvement from our side when it comes to collaborating on with the private sector. Right now, we have at least one private vendor in each of every project, because we want to learn from others and we want to be able to procure that kind of skills. But it's possible to think about also more advanced kind of collaborations, because I often hear when people wonder what we're up to, that we are overstretching. Why are you doing this? This is the role for the private sector. And I say, yes, in essence, I agree with you. The private sector will always be better than people like me from the central banking world to know what the clients need. But we seem to be living in a time in history where there's a lot of things going on. And I think we can play the role on the public side as coordinators, as facilitators, but also nudging ourselves into new equilibriums together with the private sector. And that road can be a bit bumpy because we know there are vested interests in different aspects. But I think it's important that we are there and sort of almost like midwifing the system to better places, because we want people to stay in the fiat money system, and we want them to be well served there. Mm-hmm. I'm going to take the opportunity, since you are here with me, to ask you a question.
Okay.
We didn't rehearse this, so...
I'll polish off my crystal ball.
Per, you have a very distinguished career yourself. You've been a venture capitalist, I would say, been starting a couple of firms. You have been at the PVC, the City, and now you stepped into the world of central banks. But you're doing similar things as you did in the previous life. But can I ask you, what is the biggest difference between going from the private sector into our world?
That's an interesting question, and certainly I would say both sectors operate in different ways. And one, to make an understatement, but one way that I characterize the difference between the private sector and the public sector, and certainly the economists in the room will appreciate this, but incentives drive behavior. And the incentives in the private sector are very different than those in the public sector. So certainly in the private sector, the incentives are focused on profit-driven motivations. In the public sector, we're focused on very different objectives around safety and soundness of the financial system, the development of public goods to deliver a high-value proposition to the central bank community. So the incentives are very different. And I find in the public sector, there's really just a fantastic opportunity. And I would revert back to your comment about the opportunity for collaboration between the public and private sector. And I think with our focus on our mission and value proposition of driving safety and soundness, our role as collaborators between the private and public sector is really a critical role for us to play. So I would say that's the key difference. The incentive structure is totally different, and that drives different behaviors, both rational in most respects relative to each area, but different.
Okay, interesting. Well, that concludes our vote.
Thank you.
we have a pre-recorded high-level panel discussion on the topic of CBDCs, keeping momentum in uncertain times with key central bank governors. This was pre-recorded on the 12th of March 2023. Let us now hear the discussions.
Well, welcome everyone. My name is Hyun Song Shin. I'm the economic advisor here at the BIS, and it's my great pleasure to moderate this panel taking stock of the latest thinking about CBDCs at central bank digital currencies. I think it's fair to say that central banks have made a great deal of progress in the last few years in their thinking about CBDCs, in particular how they would fit in the broader context of the monetary system, where there's a very important role for the private sector, but also where the central bank can provide this core of trust in the monetary system through CBDCs. And I think we'll have a very rich discussion here. And as you heard from Cecilia Skingsley in the previous session, the BIS Innovation Hub has been doing a great deal of work on the various aspects of CBDCs. Now, to discuss these issues, we have a really terrific panel. And let me just introduce the panel in this order. We have President Christine Lagarde from the ECB, Managing Director Ravi Menon from the Monetary Authority of Singapore, Governor Chang Yong-ri from the Bank of Korea, and Governor François Villeroy-de-Gallo from the Banque de France, and who is, of course, also our chairman here on the BIS board. So, Christine, if I may turn to you first, and ask you to speak about the digital euro. The digital euro is a retail CBDC. It's been in this investigation phase since October 2021, and the Governing Council will decide later this year whether to move into the realization phase. And both from your speeches and from other colleagues at the ECB, it's quite clear that you're thinking of this as another option for retail payments, rather than at the expense of others, but to preserve the role of the central bank, money in retail payments and offering an additional option. And there's also a very important role for monetary sovereignty. So could you give us the latest in your thinking on the digital euro?
Sure, with pleasure. So what we have been doing is, first of all, exploring for a couple of years, then really investigating and trying to sort of decipher what the options were. And if the Governing Council was to decide, so in October, we would move into the beginning of the implementation, which is not a definite green light, but certainly one that would move us closer to operating completely with a digital euro. So, I try to think of three key reasons why we're doing that. And we are moving ahead, and we are trying to be as practical and as granular as we can. I think the first reason we are doing it is for integrity purposes. The second reason we're doing it is for resilience purposes. And the third reason is for integration. So if I start with my integrity point, what we have seen throughout the euro area and in Europe in general is a dwindling use of cash. And this has been certainly accelerated by COVID. It has been tempered a bit during the terrible invasion of Russia against Ukraine, because there was suddenly a little appetite for cash yet again. But the general trend is less use of cash and more use of digital payments. The numbers are very clear. We have seen a decline of 72% to 59% in terms of use of cash, and the digital payments have virtually tripled during that same period of time. So everything is going digital. People are clearly expressing a preference for it, and there is no reason why we, as a central bank, should not be exploring also the reason why digital cash can be of good use. And as my colleague and friend François calls it, he says it's cash plus, because it is digital. Now, It is intended to be safe, it is intended to be sovereign, and it is intended to be available to all, anywhere, anytime, and at the cheapest possible cost, possibly at no cost, for the most basic functions. So that's the sort of integrity of the system, to make sure that we have an alternative to cash, and to make sure that there is actually an anchor to our monetary policy and to the sovereignty of our monetary action, which, if cash dwindles away, is then anchored into a digital payment. Now, the second aspect of it is the resilience. It's to make sure that we can safeguard European payment autonomy. Because when you look around and when you look at your wallet and you look at your telephone and see the applications that you use for payments or the cards that you use for payment, you very soon realize that those means of payments are not necessarily European. Mm-hmm. So we just have to be careful, as we have experienced recently with other instruments that are of critical use, such as energy. It's very unhealthy to rely on one single source of energy. It's very unhealthy to rely on one single source of payment. I don't need to go into the details of those who operate in that respect, but it's clearly our intention to make sure that we have resilience in that respect as well. Some people will call it sovereign autonomy. I prefer to call it resilience, because that's really what it is. And the final one is that of integration, because in Europe at the moment, there are countries that have their digital method of payment, if you will, but those are, strictly speaking, national instrument, and they can be used in Spain or they can be used in the Netherlands, for instance, because those are two countries that have it, but they're not pan-European. And they are not universal. So our point is universal, available to all. So it's also an inclusive instrument, because you don't necessarily have to have a bank account to use the digital euro, and it should be available anywhere, anytime. Voila.
It's, I guess, what we call the tangible marker of trust. That kind of sort of link, I think, is very much what you have in mind. I think this way of organizing it, integrity, resilience, and integration, I think that's a very good heading. Ravi, if I may turn to you now and zoom out and look at the monetary system as a whole, thinking about how CBDCs would fit in the broader context of the monetary system, what would be the other pieces that you think would be very important in really bringing the full potential of CBDCs in that future monetary system? And where would functions like programmability, composability fit into that kind of picture?
Yeah, thanks, Yoon. I think that's a very useful starting point, what the future monetary system might look like. But just to step back, what does a current monetary system look like? It really composes of central bank money at the core of this system. It's a two-tier monetary system, and the foundation is central bank money, upon which is private money, which is essentially in the form of commercial bank deposits. So monetary base is your notes and coins, and the reserves held, central bank reserves, the banks, and upon which the whole edifice or architecture is built. So most of our money is in bank deposits. And I think that monetary system will still be the mainstay. It lacks two features, which I think a companion monetary system will provide. So you'll have both existing side by side, and that is the digital currency system. Because our money today, well, even if it's transacted through digital means, digital payments, it doesn't have the core characteristics of digital tokens. And here it is features like programmability, composability, and the ability to settle instantaneously. So cash in physical form settles instantaneously, right? When you pay, the payment and settlement is in one transaction. But when you send it through a digital channel, settlement is not instantaneous. And this is where, as Christine said, what you need is digital cash to combine the benefits of digital and the benefits of cash. And that is what digital currencies do. So I think this second monetary system that will coexist alongside the first monetary system will have that feature. And I think it's important from the security and resilience point of view that monetary system must mirror the structure of the traditional monetary system. Two-tier system with central bank money as the core of the system, the foundation, and commercial bank money, the bulk. So I think the components there will be CBDCs as providing the foundation, the counterpart to notes and coins and central bank reserves. And we know today that private money to public money ratio is like 10:1. Most of the money we hold is private. So I think in future, CBDCs will be that base. And I think the second major form of money will be tokenized deposits, where the deposits that we have with our banks today, we can choose to tokenize a part of it, meaning we express that deposit in digital form, where our ownership rights are embedded together in the form of a token, and it can be transacted on a blockchain or distributed ledger. And that opens up possibilities to do many things that today we can't do. So I think you have a layer of CBDCs, a layer of tokenized deposits, possibly, and this is something, there's a lot of debate about, whether a third layer will be non-bank stablecoins, provided they are fully secured and backed. And that is where the challenge is. We've not found a way to ensure that yet, although I think several jurisdictions are working very hard to put in place the regulatory structures to ensure full secure backing. If it's fully secured and backing, then I think it qualifies as money, the same way your first two layers do. But I think we should not rule it out, because non-bank stable coins, non-bank issued stable coins can add to the diversity of the system and make it richer. But we need to make sure that it has the qualities of money. So I think So CBDCs, I don't think will become the major form of payment, just like today notes and coins are not the major form of payment, but it is the anchor. It gives you the trust in the system. So in future, CBDCs probably will not be the major form of payment, but it is the core of that digital currency payment system, with tokenized deposits probably playing the bigger role. So that's probably one way in which that future unfolds, because then it doesn't have the problem of disintermediating the banking system, because the bulk of the liabilities, monetary liabilities, are still held with the banking system in digital form, in digital currency form. Because if it ends up with the central bank, then central bank has to figure out who's going to do the credit intermediation process. So I think that is one way in which might evolve. Very quickly on design features, I think the singleness of money is key. The BIS has emphasized this many times, and I think we should keep that as a core of how we think about this. Today, a deposit in Standard Chartered Bank, $1 in Standard Chartered Bank is the same as $1 in HSBC, right? And it's the same as $1 I hold as issued by the central bank. That singleness of money must hold in digital currency form, and that's very important. And you can't have, and that's a problem with stable coins today. Even the securely backed ones. The singleness of money is unstable. But I think we should try to solve it. Second is open participation. These must be on payment rails that are open. And third is interoperability. I think if you have more decentralization, it's all the more important why there must be interoperability. The whole point of using digital currencies is to use it on distributed ledgers with features like programmability, with features like atomic settlement, automated market making, which means it must be part of an infrastructure of either distributed ledgers or other kinds of infrastructure that allows for this. So it cannot be separate. So there has to be interoperability rules or protocols established up front so that there is this maximization of the benefits. So I think these would be a fourth design feature is security. Absolutely. Because today's payment rails are built with a certain set of security protocols with respect to cyber, technology, risk, and so on. Now, the secondary monetary system that I'm speaking about, the new one, where we built a new set of rails, and I think the BIS has spoken about a unified global platform or infrastructure. The security of the infrastructure is critical. Yep. And the design features there may well be different from our traditional RTGS and payments networks, because these are, expressed as tokens on distributed ledgers, which brings about its own set of risks, which we need to be mindful of. So I think those are the 4 design features I would place: the singleness of money, open participation, interoperability of infrastructure, and security.
Very good. Thank you, Ravi. I think that's a very good jumping off point to Changyong. Perhaps we could discuss a couple of the issues that Ravi mentioned. One is the role of tokenized deposits, the role of intermediaries, and he also mentioned the singleness of money. Sometimes when we talk about CBDCs, one of the rationales is financial inclusion. But as we know, when a financial system already has a well-functioning fast payment system, some of the commentators might say, well, what is the additional value added of a CBDC? How could tokenized deposits really contribute to the richness of the monetary system, and what do you think will be the additional functionalities that could come from that?
I think we need tokenized deposit because the tokenization of assets is well on the way already. For example, in Korea, we have a security token offerings already, and many non-structural assets such as music, properties, and even Korean beef are tokenized. For example, like a company called Bancow is selling tokens, ownership of this calf they have purchased, is breeding, and then with the sales revenue to be distributed to the token holders once the calf is grown up and sold. So there are many tokenization of assets going on. So in some sense, in order to make, with this given high demand of tokenized asset, it's natural to think about how we develop tokenization of the, the money side. So we decide in our pilot, we actually have done a 2 years pilots previous time, and our conclusion is that Korea is who has a well-advanced fast payment system. Probably the benefit of having a retail CBDC is quite limited. One exception can be the programmability of the money that Ravi just mentioned. But our conclusion is that even that same benefit can be realized and achieved using only the wholesale CBDC. So what we decide is, together with the BIS, we will set up the infrastructure where the tokenized deposit can be issued and exchanged with the wholesale CBDC, and that has many merits that Ravi mentioned. It will maintain the 2-tier monetary system intact, and while allowing the flexibility of the bank to address the different demand from the clients by exploiting the programmability function of the tokenized deposit. So that's where we actually heading for. And another function that we are expecting is wholesale CBDC's role in the cross-border payment system. And we decide to join the BIS-led platform together with Singapore and Hong Kong, the mBridge and Dumba, and which already have proven significant benefit in cutting the cost of the international transactions and reduce the settlement risk in FX transactions. But on the other hand, we wonder whether the system can be resilient if the scale of the transaction is increased significantly. What we have in mind is some uncertainty about the liquidity provision function in the system, especially during the time of crisis. So if the global or regional safety net can provide a liquidity provision function to the existing system, it can help the system as well as alleviating the so-called stigma impact of traditional safety nets, such as IMF program, for example. What I have in mind is some kind of digital version of IMF SDR, which can be programmed in advance so that they can actually provide liquidity automatically when the crisis happens if the recipient are eligible with a certain criteria that will that can provide the liquidity as well as reducing the stigma impact that the traditional IMF program has. So all these kind of things, and actually many criteria that Ravi mentioned and President Lagarde mentioned, we're trying to incorporate in our next pilot.
I think that's a very good follow-on to the discussion that Ravi gave and some of the topics. And Francois, I think in the last two presentations, wholesale CBDCs really emerge as a very important element in the design. And of course, you and the Banque de France has really made some very big strides in thinking about wholesale CBDCs, especially in the cross-border context. So tell us about your vision for the role of wholesale CBDCs and how they fit into the future monetary system.
Thank you. May I start perhaps with a general remark on retail versus wholesale CBDC, because there could be a temptation to oppose them. I think we need both. And I couldn't agree more with everything Christine has said on retail CBDC. But there is a difference, if I may, in the situation. Retail CBDC raises huge public interest from politicians, journalists, etc., but still has some practical question on use cases. And wholesale, it's probably the opposite. The use cases are obvious, as mentioned by Ravi and Changyong, but the public interest is very low, unfortunately. So on wholesale CBDC, let me give perhaps briefly some historical perspective and say where we are now or where we should be. The historical perspective is that we central banks in the 90s invested heavily to build the so-called RTGS, real-time growth settlement system, and to put central banks' money at the core of interbanks and financial transactions. And it was a progress, and we saw it in the great financial crisis. The role of central bank money was key. We shouldn't lose that. Even if we have stable coins, but as Ravi and other colleagues mentioned, stable coins are not very stable. So central bank money should remain at the core of financial infrastructures. So where are we at the Banque de France? We are part of a Eurosystem endeavor. We have, so to say, parallel tracks. We develop retail CBDC, as mentioned by Christine, but we are also making our own reflections on wholesale CBDC. We will probably decide by the end of this year about pilots in that field. So we have been running as part of this European work at the Banque de France, 12 experiments in the last 3 years, several of them with the BIS Innovation Hub, by the way, Dunbar, Jura, etc. Let me only focus on the 3 newest ones, the 3 latest ones, because they are interesting. 2 of them are about cross-border and how to ensure the interoperability of various CBDCs. And here we develop innovative solutions, such as this is one solution we developed at the Banque de France last year, the so-called AMM, Automated Market Maker, and we strongly believe wholesale CBDC will be the key for the interoperability. The last one is about another purpose, which is also very important for CBDC, which is to have safe settlement for tokenized securities. And probably the 4 of us are ready to bet that securities in the future will be tokenized, without any doubt. So how can we assure a fully integrated and safe settlement system? Here we have an experiment with the European Investment Bank and one other central bank in the Eurosystem, the Central Bank of Luxembourg, and we strongly believe in this second purpose. Just to conclude with, to say that we published in November 21 a first report of our 9 first experiments. We will upgrade this report this year and try to draw the lessons of all the prototypes we are running.
So, Francois, maybe I can just follow up with a second question to you, just on this note of central banks actually engaging in innovation. To what extent do you think it's important for central banks actually to get their hands dirty, actually engage in the projects get down to the details and have some experience of producing things on the ground. And how much could we actually delegate that? And how important is that practice?
No, I think this is a very important question and a bit sensitive, because some commercial banks are a bit afraid of everything we have been saying in this panel in the first half about developing our CBDCs. So first, clearly, yes, we should have our hands dirty in this issue. We cannot be only on the side of regulation, private initiatives. We are part of innovation, without any doubt. That said, if you look for centuries, money has been a public-private partnership. And Ravi said it earlier, it's perhaps 10 to 1, 10 private, 1 public, but we need a strong central bank money base. It was the case in the past, it should be the case in the future. But it will be a partnership. If I come back to retail CBDCs, there was this famous issue of disintermediation and saying that we central banks would open private accounts for individual or for SMEs. No. If I take the example of Banque de France, we stopped our last private accounts 20 years ago. I don't want to reopen them. And KYC, etc., everything will be on the side of commercial banks, and CBDC will be distributed by commercial banks. There is also this fear that CBDC could take massive flows from bank deposits and create financial stability problem. No, again, the answer is no. There will be holding limits, at least in our case. So, if I dared to quote the former Pope John Paul II, I would say to commercial bank today, do not be afraid. Be part of this public-private partnership. We will build CBDC together, and I'm sure about that. Perhaps to mention a last issue, if I may, Yoon. One delicate question we will have will be the access to central bank money in this new form. At present, the border is quite clear. Banks have access to central bank money, non-banks do not. So there are sometimes reflections or questions, should we change the border? My answer at this stage would be cautious. I would say it's not because we will change the form of central bank money that we should change the border. Or if we change the border, then we will have to regulate non-banks and to supervise them. We are not yet there.
I think that's a very important message, François. And Christine, if I could turn to you for another topic that has really garnered a lot of attention, and that is the issue of privacy and whether CBDCs could be the data that's going to be accumulated in the use of CBDCs, could be misused. And I think privacy has emerged as one of the issues that has been really very much discussed in the context of retail CBDCs in particular. What would be, do you think, the design features that could really address those concerns? And where do you see the appropriate trade-off between preserving privacy and know your customer and anti-money laundering type of safeguards?
Yeah, that's a really good question, and you are right that the public is particularly concerned about privacy. All the surveys that we've conducted, the client focus group, the reaching out exercises that we've conducted have all said the same thing. People are concerned about their privacy, and there is that, anxiety of a big brother central bank having access to data. And I think that's not a very well-grounded concern. And I'll try to explain to you why. A central bank has zero interest in using the personal data of the clients of the banks, because as François indicated, the banks will be the natural intermediaries that will actually be operating what is legally required in terms of anti-money laundering, countering the financing of terrorism, and know your customer regulatory requirements. The central bank is not going to do that. So the central bank is not interested in data. The central bank does not want to monetize data. On the other hand, some of the big tech companies that are considering venturing in the field of stable coins in particular have a great interest in using, collecting, handling, and analyzing data on a grand scale and monetizing it. So I think the anxiety is misplaced in relation to a central bank, and should be more concerned about what use is made of personal data and information by some of those large tech companies. Additional point, banks, commercial banks, of course have a lot of data. When we receive our reports, we know exactly how much we spent on food, how much we spent on traveling, how much we spent on entertainment, because our banks are telling us, essentially. So those data are available, analyzed, and are of service. It's a question of governance. How is it used? Is it monetized? Is it then, commercialized in some shape or form? But it is not in the interest and in the business of a central bank to actually do anything, mess around with data. Is it going to be as private as cash? No. So a digital currency will never be as anonymous and as protecting of privacy in many respects as cash, which is why cash will always be around. If people want to use cash in some countries or in some transactions, cash should be available. A digital currency is an alternative, is an other means of payment, and will not provide exactly the same level of privacy and anonymity as cash, but will be pretty close in terms of complete neutrality in relation to the data. Now, we are looking at what would be sort of under the baseline of what we're exploring at the moment. We're looking at options to make this digital currency that we call cash plus, almost cash, with really almost the same level of anonymity and privacy as cash. And this is work in progress, which I hope we will have developed further before next October. Can I make one more point?
Absolutely.
I just want to draw one distinction, because both Ravi and Chongyong have spoken very, very eloquently and very intelligently about the programmability of a digital currency. I just want to draw the line between what I understand to be programmability of a digital currency issued by a central bank and alternative provisions. For us, the issuance of a digital currency that would be central bank money would not be programmable, would not be associated with any particular limitation, whether it's in time, in type of use. That to me would be a voucher. It wouldn't be digital currency. Those who can associate the use of digital currency with programmability would be the intermediaries, would be the commercial banks. And that's their business. They know how to do that. But if we are to say that a dollar is a dollar, whether it's cash or digital, or a euro is a euro, cash or digital, then for us, it cannot be programmable. It can be associated with conditionalities, which is different, but not programmable.
I think that's a very important point that we can explore, actually, Ravi. So how do you see programmability in this context?
Yeah, so no, I agree with Christine that the retail CBDC that the central bank issues in and of itself will not be programmed, because the central bank has no interest in programming the money. But what I'm saying is that what does a central bank issued retail CBDC do that today cash and notes and coins can't do? And that's programmability, because when this cash gets transmitted through the system, it can't be programmed. But the retail CBDC that a central bank issues as it goes through the system, it can be programmed. because you are expressing money in token form, the ownership rights are expressed in digital form, in form of a program. And so you can write into the program conditions for its use. Once that conditions are met and the money is discharged, it goes back to its original form. So it is basically the ability to write a computer software program on money to move it around for a specific purpose. And after that, it ceases, and then it can be written by others who use that money. So the way I look at programmability is that it is an option that can be built into digital currencies that make them useful. So we need to be clear in our minds, what is it that CBDCs do that currently cash can't do? And one is programmability, but mostly I would think for domestic purposes. The other is atomic settlement for cross-border payments. Because today, cross-border payments is not great shape. It's not in great shape. And I think collectively this...
What is atomic settlement, I want to know?
Atomic settlement is where you can exchange two assets in real time, and settlement is instantaneous.
It's bundling.
Right?
Bundling of transactions.
Bundling of transactions.
Okay.
And that's why I said cash, if I owe you 10 euros and I give you 10 euros, I've not only paid you, I've also settled. Whereas if I send it through the banking system, your bank and my bank has not settled. I've paid you, but the bank has not settled. This is a huge problem. It is inefficient. It is archaic, actually, in the modern age of the internet, that our banking system works like this, where settlement is not instantaneous. And you can imagine the cost. There's daylight settlement risk that all banks face. They have to put aside collateral in case settlement doesn't happen. The delay of 3 days or 2 days is an additional friction in the system. CBDCs can help to solve that, because with CBDCs, it is equivalent to cash being exchanged, euros for dollars being exchanged instantaneously. And that can be done on multi-CBDC platforms. And the BIS Innovation Hub is doing great work in the Swiss Center, the Hong Kong Center, and the Singapore Center. And many others are doing the same thing. So the key is whether this can be scaled. So I think these are the two real killer apps, if you will, programmability and atomic settlement. One is cross-border, programmability is domestic, and that's not the central bank's role. We are just making that option available. That here, I used to give you paper money. Now I'm giving you in token form the same cash, but with this feature that you can build on. And I think governments will probably use it for purpose-bound money when they want to give money to lower income groups to buy daily essentials and necessities. That can be programmed. You can actually program payments along a supply chain. If you write a program, is basically a smart contract. And so today, again, like cross-border payments, our trade finance and trade logistics is hugely inefficient. Lots of documentation, lots of reconciliation, lots of duplication work, because nobody has a common ledger. A distributed ledger means everybody operates on a single ledger. And when conditions are met, documentation is filed, payment is automatic and seamless. So these are possibilities. It looks a little science fiction because there are huge problems you need to overcome to get to that stage. But many smart people, both in the public and private sectors, are working very feverishly. And as Francois said, the central banks are getting into this, because unless we dirty our hands, we're not going to understand the intricacies involved here. So I think these are the two. So programmability is not an absolute must. That's one of the two killer apps, I think. There could be others. And this point has been made. When you make something like this, a technology available, there could be 3 or 4 other functions that come in. Just to close off, there is automated market making. Again, those experiments, we've been doing some of that, where if you can, today liquidity risk is a huge problem for all of us, and we're still facing it, right? And to look for a counterparty for liquidity. And with automated market making, you are actually trading against a pool. And this can potentially, and this has been piloted and is successful. The question is, can we scale it? And to scale it, you need a framework of trust, of who you can bring into the system. And you can, alongside solving the settlement risk problem, considerably address the liquidity risk problem. So the possibilities are boundless, and I think we need to continually innovate and experiment and learn from failure, because there have been many things that didn't work, and really evolve towards building a much better monetary system that's fit for the 21st century.
Very good. I think Christine, your emphasis on governance really is key. I think for this discussion as well. And in a way, Ravi, I think many of the hurdles will be the design of the governance, not purely the technical issues. And Chang-Yong, I think this brings me to a question for you, which is on the relevant stakeholders as central banks take the projects forward. Clearly, central banks are at different stages in their thinking and their development of these various projects. But just as governance is important in the design, and of course, I think with data in particular, already the financial system is already highly digitalized. It's just that we have a very well tested framework to preserve privacy, and the same type of design will need to be in place, even if it's a central bank that actually has the data as well. So maybe we could bring it to broaden the discussion a bit, to talk about the relevant stakeholders. Who are the relevant stakeholders that we should be thinking of as we embark and as we continue on this journey?
Do you mind if I give my comments on the Christian question first, and then move to the stakeholder issues? I think, Christian, to address that issue, single source money when the programmability are allowed for the CBDC, we believe having a wholesale CBDC, not programmable, but ask the tokenized deposit to take care of this job is the best way. Mm-hmm. One problem is that what happens if the government, for example, Minister of Finance, want to have some kind of program in distributing their subsidies. So we're going to test whether that kind of function can be done with wholesale CBDC without programmability, but ask the private sector to do it. So if that can be done, I think this problem will be disappear. Yep. As for the stakeholders issue, I think in our last pilots, we find that banks, big tech companies, regulators, and general public are important stakeholders. And probably I find that our Korean stakeholders are much more positive and demanding on this CBDC issue compared to other countries. That may reflect that crypto trading and digitalization is well advanced. For example, Korea is the third largest country in Bitcoin trading, and more than 50% of local currency denominated crypto trading is done in Korean won, and more than 16% of the adult population has a regulated bank account for the crypto transactions, which is one of the headache to me. As such, the opinions are quite diverse, and some people believe crypto is a pure gimmick and it has to be completely banned. On the other hand, some people younger generation, believe that CBDC can be a good complementary technology in providing a right way to develop the crypto and other digital technologies. For instance, one young businessman suggested me to set up a digital Bank of Korea in the metaverse so that he can promote NFT transactions. So you can see that. And our bank are more aggressive, and they believe this issue is more existential threat and opportunity. So using CBDC, they want to penetrate and integrate their banking services to the existing platform, which is run by the big tech companies or the service providers. So that is why they actually very much interested in this tokenized deposit exercises. Our large manufacturing companies also interested in. Samsung Electronics, for example, has already blockchain wallet in their smartphones, and LG Electronics is planning to launch the NFT trading platform in their smart TV, so that NFT purchasers can see their NFT, TV screens. Tech companies are very much interested to join our payment service system, and they actually demand that equal access to the Bank of Korea's large value and the retail payment system. That is a very uncharted territory for us. We have to really test whether our new CBDC platform is suitable enough to protect zero risk principle of the payment system, if the large tech companies are allowed to join. And the regulatory system needs to be more comprehensive, covering legal issues, competition issues, consumer protection and data protection, cross-border cooperation, on top of the traditional regulatory system. In sum, there are many stakeholders, but their opinions are quite varied from to one end to the other. So how to communicate them when we introduce a CBDC is a challenging task.
Yeah. Francois?
No, if I may add 2 sentences
Absolutely.
on the stakeholders. First, we shouldn't forget about merchants, and they will be very important for the success of retail CBDC. And second, about our fellow citizens and the broad public. We have probably a very strong political argument on our side, which is to maintain direct access of ordinary citizens to central bank money. In the past and still today, it was a banknote. It should be tomorrow a digital banknote. But probably our fellow citizens are not very aware of this argument. They are much more sensitive to additional services like the ones Ravi mentioned. So it's our job to explain that this political argument is very important for the future of money.
Absolutely, absolutely. So we've come to the end of our time. This has been a terrific discussion, and I will not even attempt to summarize it. But I think one thing that has really come out from this session is that we should think of CBDCs not as a standalone object, but very much in the context of the broader monetary system, and in particular in this broader context of the, if you like, the legitimacy of central bank money. It's the marker of the trust in central bank money that will clearly operate with private sector claims working seamlessly to preserve the core of the trust in the monetary system, and all these other very important features such as the singleness of money. And Christine, I just like I really like your threefold goal: integrity, resilience, and integration. I think that's a terrific way to summarize these broader the broader governance benefits actually of CBDC in the broader context of the monetary system. Well, all good things come to an end, I'm afraid. So this has been a terrific panel. Thank you very much for all your contributions. And I gather we're going to take a break.
The challenges involved in CBDC adoptions with a spotlight on legal and resilience issues. So we have our speakers on stage. The floor is yours.
Well, thank you very much. So I'm Benedict Nolens, and I'm the head of the Hong Kong Center of the BIS Innovation Hub. And I have here with me Corinne Zellweger and Maya Horowitz. So Corinne is a professor at the University of Basel. She covers both monetary, financial markets, and economic law. And Maya works for Checkpoint Software Technologies, and Checkpoint is a leading provider of cybersecurity solutions to governments and to corporates globally. I think you would know Checkpoint. So maybe to set the scene for this panel, I think, to be honest, my head is already spinning after 2 hours, or it was less than 2 hours listening. So there was a lot that was brought up. So to bring us back a little bit to the BIS Innovation Hub, we center around 6 themes. So the 6 themes are CBDC, cybersecurity, FMI, green finance, open finance, and subtech. So they're quite distinct, right? Now, for this panel, we will be focusing on 2 of those, CBDC and cybersecurity. And so indeed, there's always a good cop and a bad cop role. And the good cop is to say everything is going great, it's fine, it's wonderful, and it's going to be a success. And the bad cop role is to say, well, wait a second, it's actually really hard. So okay, in my life, I've had the chance to play both the strategy role, which is the good cop role, and the risk role, which is the bad cop role. And now we are going to have to focus here on the risk. And in this panel specifically, we will focus on the legal complexities, as well as on the security complexities and the cybersecurity issues that we need to be conscious of in the context of CBDC. So I think you heard extensively in the prior panel, which I thought was an excellent session, where Governors Lagarde and Menon have referred extensively to security and resilience. And we also heard Governor Chong Yong-ri as well as Villeroy de Gallo referring to the importance of focusing on cross-border CBDC. Now, in this panel, we will be focusing similarly, actually, on cross-border CBDC, including multi-CBDC operations, including from, for example, a legal standpoint. But we will also touch up on retail CBDC and specifically maybe different types of retail CBDC infrastructures from a cybersecurity standpoint. So against that backdrop, let me start with the first question actually to you, Corinne. So we're going to start at this stage with these multi-CBDC platform efforts. And as highlighted by the governors, we have several underway. We've done multiple experiments in Switzerland. That was Jura and Helvetia. In Singapore, that was Dunbar. And in Hong Kong, we have continuously ongoing the Enbridge efforts. So question to you, Corinne. For these multi-CBDC platforms, could you highlight to us what you think would be the key legal issues that we should be considering as we think about not just a technological concept for these things, but also bringing them actually into life and into market?
Yeah, thank you for this question and thank you for having me here. And of course, there are these key legal issues. Let me first just outline them and then make a preliminary remark, and if time allows, I will dive a bit deeper. So to just mention them, of course, we start with the applicable law. If you have involved several jurisdictions, you have to ask this question, how to decide that on a contractual basis or on another basis. That would be a thing that we have to clarify. As well as the categorization of the CBDC itself, it will be really critical, crucial how to classify whether it is a currency. Is it possible to subsume it under the existing laws? There are some laws that allow to classify as a currency, whether it would be something else, kind of a certificate of fund. I'm of the conviction it's not a debt. I could lengthily explain why it should not be a debt. No, not anymore. Of course, it's the role, the power of the central banks, how to involve them based on their existing mandate, or would we have to extend this mandate? The hub itself, the platform, what's its role? Who is assuming what kind of role, what parts should be centralized or decentralized? We have question of privacy, we have question of AML, of course. Finality, I think we will come to that in particular a bit later. Liability and, of course, dispute resolution. These are just the keywords. And something that is really dear to my heart as a scholar and as an academic that I've been for the last 20 years, I would use this opportunity here to formulate the wish to at present the central banks, and including the BIS Innovation Hub, is preparing important and extremely valuable groundwork in order to establish and enable the way for CBDCs. And to the extent that they look at legal issues, and most probably later will recommend with regard to legal issues, they act not totally unlike legislators. And that leads me to the conclusion that they should, of course, voluntarily, but they should subject themselves to some principles that apply also to legislator. And one of those principles is transparency of legislative procedure. And that implies, of course, I think that all those reports that are published are of a great interest. However, they are of an extremely high level. And what I would wish for would, I give you an example for Enbridge, as we could read in the report, there were about 200 pages, I think, commissioned legal advice from external counsels with regard to 40 or more questions. And this is something extremely valuable. Why not make it public? Because to my perception, legal questions, how to apply existing law and how to amend them, cannot be something secret. That would be something extremely valuable and is a legal question in itself, how to share this, because that would make transparent how interests are pondered and how they are weighted and why they are weighted. And this is all the more true as it's, for now, the time being, it's rather wholesale CBDCs that are developed, but the work that is set now will also be the groundwork for later implementation of potential retail CBDC. So we should involve here academic world in the discussion and give them the opportunity to, in a critical way, review those aspects. So that was the remark in itself. I think maybe, or you want me to address the one or another key
No,
issue?
I think that was very useful. So, but you need to remind me if I captured them all. So the legal basis, dispute resolution, liability, finality, AML, and transparency.
You're right. Yeah.
Okay.
Yeah, most of them. Yes.
Good. Okay, now over to you, Maya. So a question comparing financial systems and CBDC, really. So what are the key pressing cybersecurity concerns of financial systems? And in your view, do they also apply to CBDCs? And are there any unique cybersecurity concerns for CBDCs that we should be aware of?
Yeah, so I think we are talking about the security of the CBDC sometimes as if we forget that today there are many security issues with the current financial system, right? I mean, we do trust our banks to hold the record of our transactions and how much money do we currently have, etc. And it's not like we go about in the world carrying a little physical notebook with all of our deposits and withdrawal, right? So of course CBDC would complicate it, but the issue is also today that there is a lot of trust needed and a lot of security measures needed in order to make sure that this system is not broken. And it applies, that need for security applies both for the banks, but also the users or the customers. So a bank, of course, needs to protect itself from someone stealing funds, right? But also stealing private information because our financial data, our transactions, this is private information or financial information of a company that is also crucial. And then also just to keep the system on, to keep it live, because there are many types of attacks that can just take it offline, like something that we call denial of service attack, where a bank can be attacked and just stop operating, and then you can no longer do any transactions. So there are many different risks to the bank, but also to the users. We also have to trust ourselves when we work with the financial system. So today there are so many types of attacks, of phishing attacks and social engineering, trying to steal our banking credentials and then use them to transfer funds to the bad guys. But it's not only phishing where we are kind of involved, but also malware. So there are different malicious applications that can be installed on our mobile devices with or without us knowing, and steal credentials again, but also maybe manipulate our wallet, our digital wallet, to steal funds. And we see it, for example, here in Switzerland. Almost 10%, 9.4%, I think, of all the organizations in Switzerland suffered an attack of a banking malware called Qbot within the last 3 months. Okay, so that's a very large number. And also just last week, we at Checkpoint Research we found and we published a report about a new banking malware or a mobile application that tries to mimic over 20 different key financial institutes in South Korea in order to manipulate users to give their credentials. So the attack surface here is very, very, very wide. And of course, when we add new technology like CBDC, there will be more ways to attack it, of course.
Yeah. Thank you. So yeah, I think this is also the observation of the central banks who've already introduced, or at least are in advanced pilots, is that, as you say, the different types of attacks, or what you call the attack surface, is very broad. Okay, so back to the legal topic, Corinne. So going back to these multi-CBDC operations and then contrasting them a little bit to retail CBDC. So a multi-CBDC operation is intended to do cross-border payments, typically in a wholesale context. So it's quite different from a cash note today, a bill, right, or a coin. It is really a payment infrastructure. So the question to you is, do you think within that context, it would be possible to set it up as a contractual settlement finality as opposed to one in law? And the reason why this is very important is because changing the law in like 200 countries on earth would take forever. So even if it is 20 countries on earth, that would still take forever. So the point is to make these payment infrastructures, these multi-CBDC platforms, really even feasible in a foreseeable future, not even the near term, but a foreseeable future. We have to think about contractual settlement finality. And so I wanted to ask you what your view on that is, and also contrast that to retail CBDC, which maybe is slightly different there because people want to see it be used very much like cash notes, bills, etc.
Yes, thank you. I would like to take the opportunity to make a little distinction first and say something about finality, because this is the aspect that we have to clarify then on a contractual basis or on a statutory basis. And it's important to note that we have these more or less three types of finality. So we have the civil law finality, which is really the question of when becomes the transaction binding to the parties involved without any relation to a third-party system or something else. It's just when do I have the power of disposal? Am I entitled to dispose, and is there any kind of reason why this should not be binding for another reasons? Then we have the technical finality, which just occurs when I have, by software or hardware, no longer the opportunity to rewind a transaction or to stop it. And then what you're addressing, of course, is the settlement finality, which just applies within an environment where you, as somebody who provides a service, uses a system, so payment system basically, and it's the moment where this transaction becomes binding with regard to this system. And now to your question, I think in fact it would be the good way to find a solution with a contractual solution. But however, first, if you have this contractual solution, then the participants that really want to have access to a platform would have to subject themselves to the rules. So once the rules are established, I think it's absolutely feasible. It's a pragmatic way. We already have that. We know it. It's really something that we could go along. The devil is in the detail, how to define the rules first. Because who is participating in this platform and who has a say? Who's going to take the lead, and how do you find a solution that is acceptable for everybody? So even there, you will have to struggle until you have to find something. However, if it's found once, I think that this could be a solution that is viable. In parallel to defining such rule books and then by contracts implementing on the participants, we should also follow the path that has been established the last 20 years by standard-setting bodies, recommending best practices. And as I observe it, legislators quite voluntarily take over, implement in national law such best practices, and by that get closer to each other, pathing the way for later, maybe later, a solution in statutory law or international law. So that would be the way as I would see it.
And so would you see retail CBDC as different?
Exactly. I agree with you there. It's rather not the question of settlement finality. That's not so. As a consumer, I want to be sure that when I pay, it's final, it's cash-like, as you said. So here it's rather, in this context, the question of would you assign kind of a legal tender status to this kind of currency or whatever? If something has legal tender status, then normally by nature a payment is final. However, you could come to the same result also by consumer protection laws, for example. You could achieve that as well. And if you look back in history, we had important means of payments that did not have legal tender status, were freely and voluntarily used by the public. So it's not a must. Of course, it's a nice asset. If it's difficult to implement it from scratch in an existent national law, it would be viable, still viable without that. Last remark, would be extremely important for consumer, and not just for consumer, also for small and medium enterprises, which are quite comparable sometimes to consumer, is to have rules established with regard to dispute resolution, with regard to how to handle fraud events, as you just mentioned them, some kind of consumer redress. That would be something that has to be established first to spur trust in such a means of payment.
Great, thank you. So in summary, you said for these wholesale CBDC platforms, it can be contractual settlement finality, whereas for retail CBDC, it's important to focus on legal tender, but you're saying that would be ideal, but it's
in no way necessary.
Yes.
Really, believe me. It's just, I have loads of proof for that in historic view, yes. Absolutely.
Great. So maybe I go now back to Maya, back to the cybersecurity topic. So could you just let us know and educate us really on the main features of the most prevalent cybersecurity defense approaches? And if you could illustrate it with some examples, that would be useful.
Sure. So just like the attack surface we said is very broad, and it applies both to the banks and the users. The defenses should as well. And so, of course, there's the defense on the central bank and the additional banks that take part in the CBDC system. And there's no one security solution because there is no one type of attack. And so the defenses should apply to the network level, all the way to the actual machines and the servers and the cloud, if cloud is part of the solution, because the attack can be like attacking a vulnerable server with exploiting a vulnerability, or using credentials that were leaked in order to connect remotely. And so some of the defenses are also even password hygiene. Okay, that's also part of the solution. But I think that protecting the banks is kind of common practice. And I think that the more pressing issue may be protecting the users, because today, I mean, and assuming that we will probably use our mobile device as part of the system, as our virtual wallet, and today only a fraction of us actually protect our mobile device, right? We don't really hear about these attacks, we don't protect against them, and maybe it's because we don't really care enough, but now that the mobile device is money, it should be protected. And it's not only the application, like the wallet itself, just like in a bank, we don't only protect the safe room, right? But we have guards in the entrance, right? And so there are many, many layers, and protecting the safe or the digital wallet itself is only like the last line of defense. And so protecting our mobile devices, each device that has this wallet in it is crucial. And I think that another thing that has nothing to do with technology, but we need to talk about when it comes to defense is education and awareness, because sometimes we as the users or even the bank employees, okay, we all can mistakenly open the door to threat actors in their attack. And so especially when a new technology comes in, we have to make sure that everyone is educated about it. And we talked, or previous speakers talked about the fact that we want this wallet to be available for everyone to use. And so it's even people who are not tech savvy at all. And so everyone needs to be educated on how to properly use it and how to make sure that we don't open the door for the attackers.
Yeah, great. We had a private session earlier where someone was observing that we do need to think about customer-centric design for the retail CBDC. Because to a certain extent, for example, having your own wallet and the private and public key is quite a nightmare for ordinary citizens, right? So I think it links up to what you said. So maybe an additional question to you. So there's been this long-standing debate whether CBDC should be direct distributed by the central bank or should be tiered through having the banks in the system, so to say. So my question is, from an architecture perspective, do you see one as more protected from a cybersecurity standpoint because there's more gates, let's say, to the system, or how would you look at this?
Yeah, I think the easy answer is to say that the direct one is problematic because all the eggs are in one basket, right? You attack the central bank, that's it. So again, during the denial of service attack, all the financial system is down. You can steal all the money from one place. So obviously the easy answer would be that the distributed system is better. But then it also opens up more vulnerabilities because there are more institutes that you need to protect. Yeah. So more vulnerabilities, more people with high access to the system, more potential culprits in an attack. And also, it depends on who these institutes are. And I think it was Francois from the French Central Bank who said that maybe it should also be open to non-banks. So how do you vet them? How do you decide who takes place in this network? And how do you vet them both? I mean, are they good or bad? But also, are they secure enough? So who's in charge of their defenses? When there's just the central bank, you know that you will defend it in every possible way. But when it's dozens of additional institutes, who knows, right? So it all depends on the defenses eventually. So in the distributed one, when a user or a threat actor cannot have direct access to the central bank, of course that's an additional safeguard, but it needs to be architectured the right way and with the right defenses in place.
Great. So one follow-up question on this. So from a cybersecurity perspective, is a traditional system more vulnerable or a DLT system? Which one of the two?
There's no right answer to it. Because again, there's either one place of potential threat, but also all the security is focused there, whereas when it's distributed, every one of us can be the entry or the threat actor's entry to the system, but then there's also more verification. So eventually it will, it's a matter of how you do the architecture and the design of the system, and there's no one right solution. It's not black and white.
Got it. Okay, so one final question for each, one of those favorite questions. So favorite question for you, Corinne, is the trade-off between privacy and AML. How do you see this? Because there is this, people are distinguishing between anonymity and privacy, and the general public doesn't actually know the difference, to be honest, so.
Yeah, to be very brief on that, but privacy would relate to the protection of private data, and stands for the idea that you do not have to reveal those data except you have either a statutory rule stating that you have to, or you have a court order. That's the principle. Whereas the anonymity or the pseudonymity relates to a transaction where you have to reveal your identity, and then the question is to whom you have and why, and what threshold. So that's the principle, and I think it is an extremely crucial question. Nobody wants a financial system that is not fully has integrity, but on the other side, privacy is something as an institution that's not just the cranky spleen of some European people. It is really something that is at the core of every democratic system, because it defends our family life, it defends minority rights, and it defends political rights. It's a backstop against suppression, and we should move forward extremely careful and prudential in defining where do we really have to reveal this privacy, also with regard to a transaction, in order to defend some integrity. So it's an extremely difficult question, and we should be prudent, because if we look at cash payment, and I will close with that, in Switzerland, the payments that occur on a non-regular basis are in cash. It's about 40 to 60% still. You do not have any threshold where you do have to reveal your identity or to tell anybody for what you're using it, and we're not a country of criminals, more or less. So just moving this kind of cash on a CBDC basis, on an electronic basis, and just because we are able to apply any kind of privacy reducing instruments does not mean that we have to do that forcefully. So we have to really care about that.
Great. So Maya, quantum, we can't talk about cybersecurity and not talk about quantum. So what should central banks consider when they design CBDC in terms of quantum security, or how should they even consider it?
It's early to say, but I think that quantum computing, the main thing that it can influence is cryptography, and how secure cryptography is, because it makes it so much easier to interfere with cryptography. And so the two places where I see it relevant, one is cryptographic blockchain, but as far as I know, the current design is of CBDC is not to use blockchain, but if it is chosen, then this is definitely a consideration. But then also the transactions that should be kept legitimate. I mean, when I talked about securing my mobile device and the bank, but what about the communication between us? And if it can be manipulated in an attack that is called man in the middle, meaning that I ask to send, $1,000 to someone else, but then someone in the middle can change the person to whom I'm sending these funds, then this is, of course, a potential attack, and it can be enabled by quantum computing, because the encryption that I sent can be decrypted, then altered, and re-encrypted and sent to the bank. And so I think that these are the places where quantum computing should be considered.
Great. Well, that's it. We've run out of time, so thank you very much, and over to you, Ayu.
And to you, the lessons learned at the BIS Innovation Hub from our practical experimentations with cross-border CBDC. So this is still about CBDC, and this showcase will be presented by Morten Beck, head of the BIS Innovation Hub Swiss Center. So Morten, over to you.
Thank you, Ayu. So I will discuss how to use central bank digital currencies across border. And as Ayu mentioned, it is based on some practical experimentations that we've done at the Innovation Hub. We don't have a lot of time, so let's get going. So the first question is why? The simple answer is that cross-border payments are not great. They are slower, less transparent, more expensive than domestic payments, and the G20, the FSB, the CPMI, and others are working hard to close those gaps. For those of you that are intimately familiar with the CPMI FSB work program, the Innovation Hub is really focused on two of these building blocks. One is on new multilateral platforms for cross-border payments. This is the Project Nexus that Cecilia referenced in the first session, and then how to factor in international dimension into CBDC designs. But I'm getting a bit ahead of myself. What are CBDCs? We just had two great panels discussing CBDCs. So rather than adding more stuff, let me try and simplify. I actually believe that CBDCs can be distilled, I'm an economist, by the way, can be distilled down to a single mathematical equation. Have I gone mad? Perhaps. Let's see. So the right-hand side is basically short for making M0 great again. Okay, so this is base money. I guess there's a bunch of economists in the room. And as was mentioned in the governors panel, recall that base money today is cash plus reserves. So those are balances that central banks, commercial banks hold at the central bank. But I think the best example why the current versions of base money are not fit for purpose is really cash. And I was in Copenhagen over the weekend, and seeing somebody pay in cash there is as rare as seeing a fish on a bicycle. And you have to remember that Copenhagen is on the sea, and there's lots of bicycles there. And actually, kind of interesting, moreover, the central bank recently warned citizens not to take cash or banknotes abroad, as it's increasingly difficult to exchange Danish kroner banknotes abroad. So I think cash is going to slowly disappear. So the question is, how will base money look in the future? And as was already discussed, I think the BIS vision is that the base money in the future will be superior technological representations of M0 in the form of retail and wholesale CBDC. And the question for the BIS Innovation Hub is then, how can we use these new components to make cross-border payments great? And so let's have a look at what we have been doing. So here I've taken the 12 or so CBDC projects that the BIS Innovation Hub has been running, and you can see that they've been equally split between retail and wholesale CBDC. The black ones are the ones that are completed, the gray ones are the ones that are in flight, and they're also almost evenly split between domestic and cross-border. But it's clear that most of the projects are either domestic retail or cross-border and wholesale. And so what we'll focus on in the rest of this presentation are the three completed wholesale cross-border CBDC projects. And so I would say that this is Jura, Dunbar, and Enbridge. I think they were already mentioned, and they were all like major undertakings. And today I won't have time to get into all the lessons learned for the three reports, but you are in luck because last year we actually wrote a separate report that's, contrast and compare all the lessons learned from the three experiments. And recently, this very esteemed journal of Payment Strategy and System published an updated version of this article. But let me try just to highlight some very key facts of how the experiments were similar, and then I'll also talk about how they differed. So all experiments built a prototype of a common platform. So rather than actually trying to interconnect individual platforms. And they were all based on distributed ledger technology. I think the lesson is that DLT offers a lot of flexibility in design and also programmability, as we heard. And all the projects actually allowed something that is a little bit innovative, was that it allowed foreign entities without a physical presence in a jurisdiction to hold and transfer the CBDC. Very few central banks actually allow that today within their RTGS system. And then they all tested payments and payment versus payments use cases. How did they differ? Well, in many ways, here are just a few. The number of currencies they involved, Jura was Euro, Swiss francs, and Dunbar and Enbridge each involved more, actually 4 currencies. They were also different in the type of CBDC that was available for participants. In Jura, the CBDC was only available intraday, whereas both in Dunbar and Enbridge, there was the option to actually hold the CBDC overnight. And then we come to a favorite central bank word, which is control. So there was different level of controls in the different platforms. A very interesting one was Dunbar, where so-called local sponsor banks would actually be asked to do the AML or other regulatory checks. Okay, so even though it was a foreign entity maybe transferring the KYC, the AML, so on and so forth, were actually with a local bank. And in Jura, there was another way. We introduced something, it was actually a private sector innovation. We introduced something called sub-networks and dual notary signing. You should read all about it in the report, but that was actually something that really gave the participating central banks the control that they needed to have in terms of access and transfers of their currency. In terms of the operator, Jura envisioned that the operator would be a private entity, whereas Dunbar and Enbridge more relied or thought about it as being run by the central bank. And I think one of the reasons was that Jura also included digital assets, which at least in many jurisdictions now is also issued onto private CSD or central securities depositories. So these are some of the ways that the experiments were different. And I think we learned a lot also just by being in different regions of the world. So the key lessons learned. We like to say that a great innovation is something that is desirable, feasible, and viable. So if central banks were to issue wholesale CBDC, I definitely think a cross-border platform would be highly desirable. I think we have demonstrated through the 3 experiments, yes, it is feasible to build something like that. I think we believe that a common DLT platform, or especially a common platform, just has more upside. As was just discussed, governance and control are just key elements. Something like the location of nodes or the cloud, data protection, access, so on and so forth are really important issues. And then, as I already mentioned, are you going to give access to foreign entities? I think that's a real game changer if you really want to make cross-border payments smooth and easy. As was discussed in the previous panel, regulatory and legal requirements, just difficult. We tried, but it's just difficult. Scalability and resilience, as was also discussed in the previous panel, there we just need further testing. But the key thing that we didn't really have a chance to investigate, and which is still for the future, is really, are these platforms going to be viable? And I think, you know, there's this American movie where they say, build it and they will come, and maybe, but I think that's too little to hope for that. So I think there's still more work to be done in that area. Finally, let me turn to the future. I like to say that in the Innovation Hub, we pioneer. So we look at what is on the horizon and sometimes even what is beyond the horizon. Unfortunately, the governors have already stolen my thunder, so I was going to talk to you about the work that we are doing on automated market makers, okay? So this is really where we try and take technologies that has been developed in the area of DeFi and combining that with CBDCs or wholesale CBDC. So we have a joint center project that's called Project Mariana, where we're trying to build something like that, where we're basically thinking in a world where central banks have issued wholesale CBDC in a tokenized form, how would you do foreign exchange trade and safe and efficient settlement. And so this is where we are basically taking this concept from DeFi, where this is how you get from one coin to another coin in this world. So, but more to come. The project is probably going to be finished sometime around summertime in the Northern Hemisphere, so you could look forward to that. With 9 seconds left, let me leave you with this cartoon. I think it's true. Central bank digital currencies are here to stay. I don't know who the guy in the window is, whether that's a central bank governor or somebody else. But thank you very much.
It was a very interesting presentation, and we look forward to hearing more about Project Mariana, of course. And let's now turn our attention to a very timely topic, regulatory lessons from the crypto winter. So everybody, please join me in welcoming all the speakers. The floor is yours.
Thank you very much. Thank you. Good afternoon. Thank you very much to the BIS Innovation Hub for inviting us to join in this exciting summit. So this session, we are going to focus on regulatory lessons from the crypto winter. What a year crypto assets and markets and activities have experienced. About a year ago, we have had the failure of the Terra Luna stablecoin, the collapse of the asset. And then later in the year, we have the collapse of the FTX platform, the major exchange. And of course, recently we have the folding up of the Silvergate, the bank that provided banking services to crypto ecosystem. And we have a lot of lessons to learn from these episodes. And of course, we have no better person other than Steven Major, who is an executive member of the Netherlands Bank. And Steven, of course, also has the special role of chairing the crypto asset working group under the Financial Stability Board. Steven, I think the FSB has launched a major consultation report on the international regulation on crypto assets markets and activities. And you are going to finalize the recommendations. At the IMF, our board also endorsed a staff report on elements of an effective policy framework for crypto asset activities. But of course, our approach, very similar to the FSB, the spirit is to regulate. And of course, we also have views out there. The question posed is really, should we let it burn? Wouldn't that be the preferred approach? Are we actually giving undeserved legitimacy to crypto assets if we start regulating the entities in the ecosystem? Maybe we can start from your thoughts, on this one, to have your thoughts, Steven.
Absolutely. Thank you very much, Dong, for that question. Also, many thanks to the BIS Innovation Hub to have the opportunity to speak here today, and also to talk about crypto assets and stablecoins. We have talked so far about the CBDCs, and I think it's fair to say, to some extent, the CBDC started off after we had the the first stablecoin attempt. I think that really drove the development and the thinking about CBDC. So I think, although they are very different, it is important to talk about both topics. Maybe first and you said it very pointedly, is let it burn. And to some extent, I must say that would be a very attractive option, because and although we argue, and personally I also argue, is that we would need to bring this under regulation. We need to bring this under supervision. There is also this element of giving some credibility to the sector once to start to supervise and regulate the sector. I think for me the the key argument is to say we need to go on a direction and a path of regulation and supervision. It appears to be very persistent. Although we have seen a crypto winter, it is clear this is here to stay. I have seen continued interest from, let's say, first from the investors, the consumers, and we have also seen a continued interest from the, let's say, the traditional financial sector to get exposure to crypto assets, to be involved in stable coins. And of course, it's still very uncertain how it would be, but you can see that there is this drive to be involved. And ultimately, I think that is, by market participants, an assessment of the potential innovation in the sector. I must say, we've seen a lot of problems in the sector. We have seen a lot of areas where there was detriment to investors, detriment to consumers, but to some extent I think it's not to us as regulators and supervisors to judge, is this going to be a successful innovation? Is this going to be a successful new digital development? But we need to give the framework at the same time trying to control the negatives of this innovation. I think so far, and the FSB, as you said, and we'll get probably to that later on in the conversation, we have issued these recommendations. So far, it has not been relevant from a stability perspective, and I think to some extent we have seen that. There's been the crypto winter, there's been these failures with limited direct impact on the financial system. I know there was some connection in the recent weeks, but I think fundamentally these were not crypto issues. It was a little element in the developments, but I don't think it was the core problem that we have seen in the past weeks. It's right, to some extent, when you start to regulate and supervise this, you give some credibility to the sector. We are preparing in the Netherlands, we're preparing in Europe for starting to regulate and supervise this. This is as you probably are aware, this is MiCAR, and we have said to ourselves as regulator, and to some extent we have also said it to the public, is that we'll always continue, at least for the medium term, this will continue to be an area which is higher risk than the traditional financial sector. So we're not shying away as regulators. We should regulate this, we should supervise this, but I think it's also fair to say is that at least for the years to come, this will be, this will be higher risk. We will give some level of legitimacy to the sector. At the same time, we have this expectation that there will be one point in time it will become more important, will become part and intertwined with the financial system, and then it's better to regulate and supervise.
Thank you, Stephen. I think from the IMF's perspective, we have a very large number of member countries, universal membership. For a lot of emerging markets in smaller countries, there are also important macro financial implications of adoption of crypto assets, right? That these affect how monetary policy is transmitted, affects financial stability, and also fiscal issues. Are these being used as instruments for tax evasion? So all these, I think, to us, is an important subject that we cannot just let it burn. There has to be a policy framework to deal with the various risks. But coming to the risk, how do we deal with the risks? I think the spirit behind the FSB international framework, the proposed framework, is same activity, same risk, and the same regulation. That's the spirit, that's the principle behind all the recommendations. I think that's a very sound principle. To the extent we can classify all the activities of the crypto space and the risks into the framework we have now, right? So the question is that, can we actually do that for the crypto activities? Can we classify them, bring them into the existing regulatory framework and apply the same regulation? Or to put it differently, can we really believe that crypto assets, or can we take a technology neutral or agnostic view towards crypto assets? Or do these new technologies actually bring new risks that are not captured by existing frameworks? Maybe I think that's a question that's being on the mind of many, many regulators. Would be very interested to hearing your views.
Well, maybe the answer probably is going to be a bit ambiguous, how do you say, twofolded. So first of all, and I think that is clear, as we have seen also on the CBDC discussions in the previous sessions, you can convincingly make the argument is that crypto assets and stablecoins are in an innovation, they are a new development, and so the nature of that development is different from what we have had in the past. On the other hand, if you look at the type of issues that we're confronted with, they are quite traditional issues. We have seen the collapse of the FTX, and of course this is based on public information. You have seen very classical issues at play that we to some extent solved and addressed in the traditional financial world, traditional financial system. The fact that you shouldn't mingle customer accounts, customer resources with your own resources of trying to develop a business. It's an age-old mantra in the traditional financial system. There's a high risk of investor detriment if that is not solved, and we have seen it playing out. We have also seen it out, and as you probably are aware, I've been a securities regulator in the past. The fact that you can trade and also take positions in instruments, and at the same time, be taking a position as, let's say, as a market maker, but also offer the exchange, that you combine those functions. These are typically situations of accidents waiting to happen, where there will be problems for investors. And so, in essence, the underlying risks are quite similar, and that is the reason that we have said same risks, same regulations, and in that sense also we need to be not to be, let's say, get distracted by this idea. This is going to be a fairy tale world where suddenly self-interest doesn't apply and where there's not going to be any accidents. This needs to be a properly regulated and supervised world, and that is also, if you go to the recommendations that we have developed as the FSB separately for the crypto assets and for the stable coins, they are quite standard kind of regulatory considerations that you expect, like proper governance, taking into account, making sure that there are proper supervisory tools, that there is supervisory cooperation. And so in that sense, the substance of the recommendations will to some extent not surprise you, because also we think that in this world of crypto assets and stablecoins, that you need to have some similar regulatory and supervisory principles as we indeed have in the traditional financial system.
Right. So Stephen, in the Netherlands Bank, you have recently fined 2 service providers, I think 3.3 million euros, if I remember correctly, for not having registered their services. Nonetheless, they are providing services to the citizens in the country. I think this is going to be a problem for many other countries, in the sense that crypto assets by nature are really cross-border. They are borderless, and they are by nature could be anonymous, so the service providers can be located anywhere. Actually, I think my colleagues in the Monetary and Capital Markets Department in the fund, we did some calculation. 80% of the crypto assets service activities are provided by service providers located in the so-called offshore financial centers. And of course, you can market your services across the globe, using the internet. For a smaller jurisdiction, it's very hard for them to find some of the big service providers, let's say, how to ensure compliance. So this points to the broader issue of international collaboration, of regulatory enforcement. How do we regulate activities that are international by nature? What are the means of collaboration? What about the jurisdictions that don't necessarily adopt the FSB standards, right? Maybe they have capacity constraints, they have a different regulatory approach. So how do we ensure consistency and have a globally coordinated approach to crypto asset regulation in order to prevent regulatory arbitrage? I think, maybe your thoughts on this question?
Well, maybe first on without going into, as you said, this is public information around the fines for the two, let's say, global crypto players that were active in the Dutch market. And of course, there is an issue then, because in principle, every global crypto player can be accessed by an investor or a consumer, and so there needs to be this link between that there is evidence that actually they are providing the services to the let's say to your jurisdiction, to the locals in your jurisdictions. First, maybe on this issue of non-compliance, because it's also part of the recommendations that we have consulted upon as the FSB, is that we also recognize that there are non-compliance issues generally within the sector. The level of non-compliance varies from jurisdiction to jurisdiction. For example, in some jurisdictions there are some different definitions around when is it a security or when is it a deposit, etc. And so whether there is non-compliance or whether you need to have new dedicated rules and regulations will also depend a bit on the existing, let's say, legal framework that you have. I find it very interesting that there was quite some attention to legal issues in the previous sessions. So in addition to that, there is indeed the point of global cooperation. Obviously, what is important, and that is also what the FSB is saying and will continue to say, it is important once we finalize the recommendations before the summer, that is our plan, that is our intention to finalize them before the summer, is that jurisdictions across the world should implement them as much as possible. And so that is important. That is, let's say, the first line of defense, making sure that they are implemented as much as possible, those recommendations across the globe. We have heard various stories. There's already been some jurisdictions that have implemented dedicated rules and regulations for crypto assets and stablecoins. Depending on your regulatory system, they may already be covered to some extent, and so, but that is the baseline, is to make sure that the recommendations are implemented. At the same time, of course, there is the issue is that there may be some incentives for some smaller, lightly regulated jurisdictions to maintain their stance and trying to attract some crypto business. And I think we need to think about how to go about that issue. I think it's not sufficient to just stay and continue to make the point, you need to implement this. I think one way to look at this is to say, well, maybe you should take into account that, let's say, in your jurisdiction, that the jurisdictions that implement those standards, they can only allow their traditional financial institutions to get exposures to crypto assets and stablecoins coming from those jurisdictions where they are regulated. And so, of course, we have seen these mechanisms also in other parts of the financial system. There are some ways to address issues with jurisdictions that are not willing to implement rules and regulations, and to find some mechanisms. I think we're in the middle of thinking about that. We had some discussions on that in the FSB. We haven't finalized our thought on this, but clearly, for me, it's clear that just saying, implement these rules and regulations is not going to be sufficient. We also need to have some mechanism where, for example, you limit the opportunities for the traditional financial sector in regulated jurisdictions to get exposures to crypto assets and stablecoins from those jurisdictions that do not implement regulations. Maybe because you raised that in one of your previous questions, we are also very recognizing the issue around, for example, stablecoins. having a bigger chance of, let's say, being successful in some emerging markets, developing economies. We recognize that the attractiveness of stablecoins will vary also. To what extent is it easy in your jurisdictions to exchange money, exchange currencies, how much cost is involved, how efficient are payment systems, and we can see that stablecoins can be more attractive to emerging markets and developing economies, because there are, it might be more expensive to get a currency to have remittances, for example. And so one of the issues that we also want to focus on or give attention to is precisely these risks around stablecoins and the implications for emerging markets and developing economies. At the same time, I should also say we always look at the stability angle, and so I can see the issues around, perspectives from monetary policy, perspective from fiscal policies, money laundering. They're all very important, but from an FSB perspective, we focus on the stability side.
Right. Thank you. So just on the macro-financial aspect, for a lot of IMF member countries, of course, capital flow management is a still important toolkit in managing volatilities associated with cross-border capital movements. And one reason that crypto assets could be a concern here is that they could bypass some of the traditional control points in terms of capital flow management. So what are the channels that these measures can be circumvented? And that's something we also are studying very carefully in the fund. And what are the mechanisms we can close these loopholes? There's some similarity to the thinking here as well. So that's an ongoing challenge, I think, to a lot of the member countries. Just to follow up a bit on the FTX failure, you mentioned that we have seen the development of this very large multifunction service providers. So what are the lessons we can learn from this episode? But more broadly, there is an interesting question in terms of the crypto asset itself, because we have thought that blockchain really allows for the possibility of a decentralized setup, right, for financial services. But the trend we have seen is really a centralization. We have seen out of these activities the growth of very large firms centralizing services. So, two questions. One is more specific in the sense that what we can learn from the failure of this big service provider. And secondly, going forward, looking in the future, what's your thought on the various sort of the underlying development of crypto assets in terms of, the so-called trilemma in blockchain, right? Do we have a sort of trilemma in terms of decentralization, security, and scalability? Is it really sort of because the technology has not developed to the extent that it can be scaled up without being centralized? In the sense that the fact that we have seen so much centralization of services is a reflection, probably the technology has not developed to such an extent that allows it to be scaled up without centralization. I don't know. These are some of the thoughts that are still being debated.
Well, maybe still going back to the point that you mentioned at the beginning of your question around the issue that stablecoins or crypto assets may become important in emerging markets, developing economies. Where personally I could very well see is that at least you want to have the information exchange and the supervisory cooperation. Is, for example, is that you can know at least as a jurisdiction if there are instruments or stablecoins or crypto assets active in your jurisdiction, is that you get information from the home regulator or the home supervisor, and because you want to know how important is this, what is the scale. And so I think at least you would want to have there a solution of information exchange. The whole thing on decentralization and, again, I'm as a regulator and a supervisor, I'm by nature, I'm a bit skeptical, and it's interesting to see how extremely centralized this world is. There's actually not so much decentralization. I know this was at the origin when going back to, 2009, 2010, that there was also a philosophy of we shouldn't have. We need to have money. We need to have coins which are not part of a governmental system, and therefore we need to develop crypto assets, bitcoins, etc., to take them private. Well, first of all, and you wouldn't surprise me, although I'm responsible for banking supervision, working at a central bank, I'm convinced, and it was exchanged in the previous panels, about the importance to have the public interest embedded in our financial system, in our payment systems, and I think what the FTX case shows is how centralized this is and how important key players are in this market, and of course. We know, and I know that some of the people in the sector say, well, but that is the reason it was not successful, that it was so centralized. Go to the true DeFi, and when we really decentralized, all things will get, this will be addressed. I think it is in our, and again, as I just said, we can see that there can be innovations in the sector. There is a chance. We should give that the room for that. We've seen a lot of problems in the sector, and to some extent, a lot of problems related to this concentration issue. The fact that you can be both a trading venue and taking a position and taking custody is creating risks in the sector. And so I am pretty optimistic that ultimately, and that is having the supervisory hat on, that ultimately we will find a person or an organization to regulate the sector, because there's been concerns around if it's so decentralized, can you properly regulate this? I think we need to be creative. There needs to be thinking about where the anchor points would be to regulate and supervise. We have the same type of creativity and innovation in the traditional financial sector, because, for example, now in the EU, we have decided, we also talked on issues like cybersecurity, is that we also look at suppliers and supervise, let's say, key service providers to the financial sector. I think it is also possible to properly regulate this sector. It will have a different structure, but ultimately, I think there will be the possibility to find the key players and link the supervision to make sure that we can effectively regulate and supervise.
Thank you, Stephen. I think we have just over 3 minutes. Maybe I can open the floor to one or two questions. I don't know whether any colleagues in the audience. Yes, we have one hand up over there, please.
So my question is about the implications of greater regulation on the crypto ecosystem, its implications for the degree of integration with the traditional financial system. So on the one hand, one could think that greater legal certainty could increase this integration. But on the other hand, to the extent the ecosystem derives its existence from regulatory arbitrage and lack of genuine use cases, then this could lead to lower integration. So what are your views on the way forward from here if we regulate it more strongly?
So the very, very good question on the as we have seen so far, the level of integration has been limited. As we have seen how the crypto winter has developed, of course, there's been very painful damages for individuals that had invested. Although, for example, the information in my jurisdiction is that there were a lot of people involved, but most of the people in quite small amounts. Understandably so. I think regulators across the world have been quite strict on getting exposure for the traditional financial sector to crypto assets and to this new development. You're probably aware of the Basel Committee standards that are quite strict in terms of the capital levels that are required. I think a possible outcome of regulating and supervising the sector, and as I just said, we hope that it will happen based on the recommendations that we have issued, that will gradually increase. But as I said, as it's regulated, I think that is a development that you could expect, and so. That is, I think, part of the future development. If there's innovation that passes the use case, where there's relevant benefits to the financial sector, and I think part of the result of regulating and supervising this will also is that the interlinkages will increase. But of course, we will be very careful. The Basel Committee has been careful on this to make sure that it will not have negative consequences for the traditional financial sector.
I have one hand over there. I think that's the only one we can accommodate given the time limit. Thank you.
Can you hear me?
Yes.
But I think the people that are listening remotely probably know.
What is the answer of the question? Thank you. My name is Amnon Samit. Short question to Stephen. What is your attitude towards local community money, local community coin or community digital coin? Like Amsterdam is considering, Ireland, I think, has already such a coin. What is your, as a national bank, approach if communities will develop local CBDC? Thank you.
That is very. Actually, you know more about the Netherlands than I know. So I wasn't aware of these developments. To some extent, you're moving to my central bank side, and it's a little bit out of my comfort zone as I'm responsible for banking supervision. I guess my people in the central banking side would say that as long as that stays small and limited, there are these options to have that. I guess they will start to be more concerned once it starts to be bigger.
Thank you. Thank you very much, Stephen, for sharing these thoughts. And
thank you very much, Dom.
Thank you very much.
Welcome back, everyone. So, what might the financial market infrastructures of the future look like? Let's now turn to a discussion on cross-border trends in payments and beyond. I will now give the floor to the speakers.
Thank you, Ayu. So despite the fact that I look now much older than my headshot, I'm Andrew McCormick, the center head for the BIS Innovation Hub in Singapore. It's an absolute honor to share the stage with these three amazing leaders in the payments industry, each representing, I think, very unique constituencies and have great perspective on the future of cross-border payments in a digital age. We have an incumbent from the SWIFT, a regional visionary from P27, and a digital giant from Asia, who are here to face off over what the future of cross-border payments are going to look like. Saskia de Volder is head of Europe North for SWIFT, responsible for GPI, Global Payments Innovation, and market infrastructures in EMEA. And prior to joining SWIFT, was a VP of Global Account Management at MasterCard. SWIFT obviously needs no introduction as a member-owned collective serving 11,000 financial institutions and then really critical infrastructure for the global financial ecosystem. Paula De Silva, CEO of P27, Nordic Payments. Paula has 30 years of experience in the financial sector, and prior to joining P27, held senior positions at SEB Bank. And P27, for those who don't know, is a joint commercial bank-led initiative that aims to build pan-Nordic real-time payments infrastructure for cross-border payments in the Nordic currencies and the euro. And Carrie Suen, who is a global senior advisor at Ant. And Carrie joined Ant in 2014 and is in charge of global affairs and oversees legal and privacy functions at Ant International Business Group. Ant, of course, serves over 1 billion, many more users, 80 million merchants, presence and recently launched an interesting cross-border payment service in Asia that we'll get into a little bit later. So we'll dive right in, and cross-border payments are, of course, a critical area of focus for the G20, for the BIS, the BIS Innovation Hub, the FSB, the CPMI, and amongst other things, we've tried to set quantifiable goals for reducing fees, improving access, speed, and enhancing transparency. So we'll start by focusing on the pain points themselves, and from your unique perspectives in the market, how do you see the key problems that you're solving? Who are the users and clients that are most affected? And what are the biggest challenges in overcoming these challenges with the infrastructure, the regulation, or those deeper layers? And maybe I'll start with you, Saskia.
Thank you, Andrew. First of all, maybe a little something on SWIFT. We are a cooperative. That means we don't go for profit maximization. So there is something in the private sector that doesn't really go 100% for profit. And I would not call us an incumbent. I would call us the first fintech that was there almost 50 years ago, because we transformed the world from manual and telex into automation. So I think that's the first fintech. And we continue to be a bit of a fintech, but maybe a bit indeed. I'll come to that later on, a little bit on the different side. But what do we see as issues with cross-border payments? Our industry is about, all the banks, 11,500 members, more than 200 countries and territories. But it's only since a couple of years that we've been able to actually track and trace transactions end to end. Before, there were messages. We could not see where they originated and where they ended. Since GPI, we can. And what do we see as reasons why transactions are not that fast? Well, there are a number of them. But first of all, I want to correct. Cross-border transactions are not that slow. Over 60% of the transactions over SWIFT are done in 30 minutes. I think the KPI of the G20 or the FSB is 75% done in an hour. So actually, that's not that bad. But yes, there is still, a certain percentage that is not executed in those 30 minutes and even can take up to almost a day. And what are the reasons that we see is, I think the first one is currency and capital controls, because most of the delay is on the recipient side. So the transaction is executed quite fast into the country of the beneficiary bank, but that is where then the delay takes place. The beneficiary depositing the money on the account of the beneficiary is due to currency and capital controls, is the first one. Two is the capability of the bank to process 24/7, or batch processing that is still there in certain banks. But also the RTGS, I think it was mentioned very early that RTGSs could look at extending opening hours. They're not always open. So if we want to have finality, if we want to have settlement, the RTGS needs to be involved. So there are still a number of issues that come into play to increase the speed. Now, I also want to say that the industry overall does already certain elements which make that speed go faster over the last few years. And I think I need to mention common language. Well, first of all, I'm Belgian, so I speak Dutch, like a few of you here, I think, from the Netherlands. But if I would speak my language, you probably more than half of the room would have no idea what I talk about. So we agreed on a common language being English. Well, last weekend, we started a migration to ISO 20022. Europe, Canada, a few other countries as well started a migration, but also on the cross-border space, SWIFT started the migration to ISO 20022. And that migration is important as a common language, but also to make sure that we all can use those data elements for the future. And so I think that will help as well to increase speeds in the future.
Fantastic. So the first fintech, I'll make sure to update my speaking notes next time. Yeah. Paula, can I go to you next and give us your perspective on the pain points that you're solving for?
How long do we have now?
23 minutes and 39 seconds.
No, but I think there are quite many. I mean, to start with, we talk about cross-border. If you are in China, you have, 1.3 billion people. They're domestic. Why are they different from the others? If I want to pay and I have a merchant in the country and then I have it outside. How can we harmonize that? I think the banking industry is today financing things that they don't want to finance involuntarily. And one of the things, you use ISO 20022, and that's great to migrate to that. But we need to harmonize so that we actually have a chance of monitoring what we do. And we don't do that today in a good way in the whole industry. So in that sense, I think it's quite important that we standardize across. And to your point, it's a common language. So let's say that if English is a common language, then it goes cross-border, right? So we need to enable that in a good way. So the pain points are quite many because of that. I used to work for this quite international Swedish bank. I think they had 600 payment types that didn't talk to each other, X amount of payment systems and so forth. So we need to really go in there, and it helps what the SWIFT is doing for sure and setting standards. But then we need to harmonize across. So domestic payments is a big pain. That's one pain. The other pain is, of course, that we have a regulation that is quite different. So it's like if we had a traffic system that, in this country, the stop sign looks like this. It's red and it's 6 corners, and the other country it's something else, completely different. It's green and it's round. We wouldn't understand, and that's a little bit the same as we have here. And even in our small countries up in the Nordics, we are still quite scattered. So that's a pain point that P27 obviously will be trying to solve together with, and absolutely not proprietary. It's an open space, and we need a lot of collaboration. And again, harmonize the standards that the global organizations are setting. But we need to do that cross-currency within and outside the countries, I think.
For sure. Carrie, I'll go to you next.
First of all, thank you for having us here. And just responding to Siska, actually, now with all the crypto disruption, I feel like what Alipay and Group is doing is we almost become incumbent in a sense. So I'm going to be quite, in a very layman term, I think one key objectives that we're looking at here right now, all the efforts that G20 is pulling together is really to enhance the financial inclusion. But I want to take a step back and look at the bigger picture, right? When you say financial inclusion, who exactly are you solving the pain points for? I think that is a very important question that we should be very clear. And from our standpoint, from our experience, we are operating a very vibrant but also very diverse environment with banks trying to go digital, with big techs, small techs, fintechs, all coming together to try to join this fintech movement. And who are on the receiving side, who are the one actually using the last mile delivery of service. I think that is something that I feel may not always be highlighted. I think what one of the panelists mentioned, merchants are also quite key to the whole development. So when we talk about who are suffering, I think global SMEs, they form 90% of the companies worldwide. They actually contribute social impact, employing 50% of our population and contribute 40% of the GDP. But I think there's a lot of legacy system that were not really built for them. But yet, because of pandemic, I think there's more emphasis on looking into the SME economy. So I think payment itself is the first step. And let alone all the accessibility to financing, to credibility, to trust data, etc. that we are going to talk about. But I think so. Looking at from SME's perspective, they need to have that digital mindset. But digital mindset does not just come naturally. So I think we talk about costs, accessibility, speed, etc. But I think one thing that was not emphasis is the user journey experience. Because if you talk to a woman entrepreneur in a village doing handcrafts, for them that experience is very different. Like how do they even get onboarded, to get used to that digital capacity to use the technology itself so they can get a chance to access the system. I think that is something that currently, I think this legacy system was not built for. But I think this is good. I'm very privileged to be here. I think it's very encouraging. I think there's a collaboration here to look into, how we can upgrade that system, and then on top of that, how can we encourage more innovation on a very stable, resilient, and also safe environment. So I think that's something that we should keep in mind on when we look at the next generation of financial system, who are the stakeholders that are within that ecosystem, and what that end-to-end flow is going to look like. And from an architecture perspective, how do we build one layer on top of the other, and then at the end, when the product financial service is being offered to the end users, then they can actually use it and it's implementable.
There's a lot there to pick up on, and maybe what your comments there, Carrie, about the commercial layer is actually more nuanced. We tend to be fairly bank-centric in our thinking, and guilty as charged. But if you think about the commercial layer being banks, it's telcos in some countries in Southeast Asia that are offering banking services, basically payment services. It's big tech players and fintech players, and then maybe at this outer layer there's this experimental layer that kind of is the crypto sphere or whatever. And that model, that mental model that reminds me of is this idea of pace layering, and there's kind of the regulation and the infrastructure at the core, but then the commercial and the experimental layer, and the outer layers move very quickly and the inner layers kind of move rather slowly. And our mission is to try to figure out a way to make sure that middle layer responds to change and adapts to change somehow. So there's something there that I'll have to sort of noodle away on, but I think that it's really relevant, and certainly now spending a bit of time in Southeast Asia, I sort of now appreciate the magnitude of the services that are being offered to un- and underbanked populations, hundreds and hundreds of millions of people being now serviced through digital payment means, and we don't have a great access model to be fair. So from that perspective, if you think about that pace of change at the infrastructure layer, and as the first fintech, Saskia, I'll start with you in 1977 when you guys started operating. How does SWIFT kind of reconcile that infrastructure change management program, and what are you working on specifically to try to evolve those services to be more digitally native and ready for different access models in the future?
Yeah, thank you for the question. And yes, it's true, we're there since 1977. We did the first transaction. And we need to, first of all, I think our role is to guarantee stability, The exchange of money is there, and, nobody talks about SWIFT when everything goes right, but hell, everybody talks about us if we're not there a couple of minutes. And especially when times are volatile, we see the importance of the role that we have. And coming back to our role is also the trust. The last 2 weeks, I would say, there's a lot of discussion about trust in the system, and we give trust to everybody which is operating, which is market infrastructures, which it's central banks, whether it's commercial banks, whether it's, everybody playing in the securities or the trade. So we give trust because everybody is guaranteed a layer of security, a layer of interoperability. I think Maya was talking earlier about cyber protection, when we designed the whole CSP, where we looked also at outside of SWIFT protection against cyber, not only at ourselves, but also to every single bank and every single country and every corporate and everybody dealing on our network. How can we deliver the highest protection? So it's about trust that we deliver in our system. So that is, I think, fundamental. It needs to stay because that's still the way everybody exchanges money, or actually data, because SWIFT doesn't move money. We move data around to make sure that you can execute payments. But then, yes, we want to innovate. And maybe the difference between a fintech and the fintech called SWIFT is that when we innovate, we do that with our community. We do that in agreement with, all these banks around the world, and we move them all together at the same time. We don't move 20 of them and we say, hello, here we are, we have found a brilliant solution. We move it actually cross-border. So if you look at GPI, which is like 3-4 years ago, where we can now track and trace, then we also detect all these issues. So coming back to some of those issues, how can we make sure, we think with the community about how can we come to our strategy and the G20 objectives is, how can we come to instant frictionless payments? Well, I think you know that as well from your project is if you do pre-validation, you can already anticipate, that there's less issues when afterwards you do that transaction. You can exchange already certain information, verification of certain information. So, we're moving the community and helping the community with doing pre-validation. We want to build, like Swift Go, more SLA, but based on that layer of GPI, which we have, I think, demonstrated globally that it really works, that we can track and trace, that we can see issues, we can solve issues. So if we make SLAs tighter, we can actually try to make it easier for everybody, as you mentioned, in the chain, whether it's a consumer, whether it's a merchant, to know more how it will work, what to expect, and to guarantee for the banks, the easy execution of the promise that they have made to their customer. Because finally, when we deliver those services to banks, they make promises to their customers, whether it's a corporate or a consumer, and they want to keep those. So we're looking at pre-validation, and then coming back to I think the topic that has been discussed a lot, CBDCs. Digital currencies, great, I think, everybody's looking at renewing, but we'll still have, for definitely a number of years, we need interoperability between that new system and the existing system. And that is, I think, where we have been working with like Banque de France and Bundesbank and others and a lot of commercial banks as well to test how would that work. We want to guarantee stability of the financial system today and tomorrow. We exchange data. We want to protect that data on our transaction manager, make sure it's well protected there. And I think one of the previous panels talked about the whole data and the protection of it and privacy. Well, we want to make sure that on our transaction manager is well protected, but that we pass on what is required for a cross-border payment, because cross-border payment has two differences from a domestic one. It's doing the FX, you need a currency conversion. And two is the whole compliance requirements. And so we need to make sure that that data is there available for everybody to fast, but well, and trustworthy execute their compliance requirements. So yes, innovation and CBDC interoperability is high on our agenda, but it remains at the top level. And as I said, we slowly move the ground layer, but we want to guarantee that SWIFT is there and that the system can work today and for the next coming years.
For sure. For those keeping track, it was officially 17 minutes and 51 seconds before CBDC came up in this conversation. But thank you for that, though. Paula, I'll go to you next. As an emerging regional infrastructure provider, what are your kind of key lessons learned thus far on your journey?
But I liked your mental journey there about the pace and how quickly and how slow. We are slow, for sure. We are not setting standards, but the mission is to transform the market. So it's not to launch a product, and that takes time. You need to syndicate. Swedes are known for consensus. I think Cecilia can say that. So it's quite important that it's smooth, and that's what we are trying to do. And therefore, it's 101 banks in the region, okay. 5 different countries. Over time, we are 3 right now that are adhering to it. Quite a lot of different legacy systems, even though all currencies are basically fully digital already today. For those of you that have been in the Nordics, try to pay with a bill, you notice that it's impossible, more or less, which means that you have a system already that we need to go from. And 1959, the Swedish ACH was built. So it's quite cool, old, maybe even older fintech.
Maybe that's the second fintech.
Yeah, exactly, second fintech. But even so, it's quite slow. It's quite scattered. So the transformation takes time. You need to onboard everyone, and not only the big banks, but really the small banks as well. So we are slow, but we are proud of being slow in a way, making sure that everyone is on board. And then, of course, we collaborate with the Swedish Central Bank and the other central banks in the region, setting the bar for how much resilience and so forth there needs to be, together with the monitoring entities as well. So there is a lot of collaboration. There needs to be a lot of collaboration in this space. So based on the standards that you guys set globally, we can adhere to it locally, but also to then satisfy the local needs. So hopefully a combination of that in an open space. Yeah. Big task.
Sure, absolutely. You mentioned kind of the speed in which you can launch infrastructures, and certainly in a banking context, I totally agree. It feels slow at times, and I've been there personally as well. But Carrie, one of the things that we do observe in your world is you guys do move a bit faster than us, and I think that's interesting to see, because this digital wallet universe is somehow inherently faster moving, serving vast numbers of customers. There's still KYC and appropriate controls on who those users are, but is Alipay Plus essentially trying to be kind of an infrastructure for digital wallets in this realm, and is that your kind of answer to what the digital future looks like for cross-border payments? Are you now an infrastructure? Are you the third? 1, 2, 3?
I'm glad you asked. Yeah. I mean, from our perspective, because we have our own wallet in China, and what we're doing outside of China is actually a bit different. So we had that brief discussion before. I think from our point of view, like actually the digital platform, whether it's wallet, banking apps, or e-commerce, they constitute an important part of that whole financial infrastructure, if you look at that way, because it provides a very simple access point to the end users. And from that perspective, there will be valuable data set that can be gathered, obviously subject to privacy protection and consent. But to many people, especially those unbanked, that actually gives them access to the market, which they have the ability to start accumulate, the data, the credibility, and hopefully that will bring more value-adding service to them. So from Alipay Plus perspective, we are a B2B solution that aims to help propel these domestic wallets, banking apps to go cross-border. Because I have an ex-colleague sitting right there from Ant. So she left us 5 years, but we have been looking into this space since 2015. It is not easy. Just if you are trying to build one corridor, you have to deal with probably 3 or even 4 different jurisdictions. So that differentiation in the regulatory requirements itself is quite burdensome. But we dealt with a lot of wallets who are growing, who are trying to get ready for that cross-border global trade business. It's not easy. Today, if you're number one in your market, then you have the choice to connect with the global merchants that you choose, where you think your users are going to. But it actually sucks up a lot of cost and resource. So a lot of these wallets, they're very money-burning business, even in the domestic market. So they don't really have all those bandwidth to deal with all these cross-border issues and system building. So what we are there to help bridge that gap, and they have a choice to go directly, but they can also use our service. And on top of that, as all of the global policy makers would know, when you go cross-border, the risk, the regulatory requirements also have a higher bar. So a lot of these digital wallets, they need that technical capability to meet those requirements, even on the SLA, right? How to ensure there's a cross-border seamless experience. It's actually all very technical. It's not so easy, just switch on a button and then it will happen. So there's a lot of computing processing system required, a lot of product features that require to maintain that seamless cross-border experience for those wallet users. So what we have done is actually we also license our proprietary license technology on AML, screening, risk management, on eKYC. So in a way we can help them to step up to that higher threshold that is required for that cross-border payment processing. So I think what I'm trying to say is I think from my personal view is the cross-border payment space will continue to be fragmented because there are a lot of different needs depending where your economy stands and what are the political agenda that is set for that sovereignty. But what is important is to have this layer of application where you can actually be interoperable with each other, what P27 and SWIFT are doing, but also to have that solution to bridge those gaps, and hopefully will be a more sustainable business model for all the ecosystem players that are coming into this cross-border payment space.
Okay, well, we have a few minutes left, and I know there's lots of smart folks in the room, and I think we have some time for a Q&A. So I want to see if there's any really tough questions that you guys could throw at my panelists in these last few minutes. I think we have someone who can bring a microphone around. I'm not sure who, but I see. I believe that's Jesse from MasterCard.
So you're all representatives of private, or in the case of SWIFT, cooperative entities engaged in this space. We have lots of attendees here from the public sector. I suppose, if there was one thing that you would ask of them in terms of the role that the public sector can play, particularly perhaps around the space of regulatory harmonization, what would it be?
Who wants to start?
Well, I can start. We are, trying to go cross-border. 3 countries might not seem like a lot, but very, very different at the start. So we have 2 countries with ACHs, 1 country without, Finland, to have direct connections. Totally different views on most of the things. Actually, now being much more harmonized, as maybe we also force it into the system that one needs to have the same view, and also the central banks looking into what's happening in the world, harmonizing, demanding more or less the same thing. So that is needed, to your point, and as I said before, one needs to have the same traffic light system, otherwise it's difficult to deliver, to your point as well. So that would be the wish.
Carrie, what about you? What's your one ask of the BIS?
I think Sandbox approach is a very good platform to come together to look at that. I think what Cecily alluded earlier on, BIS is also very ready to get into more of the private sector space. So I think now that line is getting a bit muddled, right? So can we have a global sandbox approach where, parties can come together to experiment and talk about issues, and then see how we can all use data, use technology to facilitate with the risk management point of view, right? I think also there was some mention, I think we need to have baseline understanding of where the minimal risk threshold lies, and it could be activity-based, right? What MAS has done with the PSA legislation. So I think we just need to have that common language to understand what cross-border transaction looks like, what are the essential data set that is reasonably requested, so we can actually clear and settle a cross-border transaction. Even that, I think there's a lot of different interpretations across countries.
Saskia, anything to add?
Well, first of all, I think they both made already great points. And I would say, to add to that is indeed, let's work more together. Let's try to find solutions together for some of the points. I think in some areas we do, but I think we can go further. And especially these are, everything which is related to regulation, compliance is non-competitive space. It's a space where we can only all win instead than lose if we really work together. So I don't think that has anything to do with commercial or any other thing. So I would say, go for a bit more exchange, listen to each other and work together, and maybe sandbox and testing is a good way of maybe trying that more.
Great. Well, thank you so much. We're out of time, and appreciate all your wise comments and wisdom. Thank you so much.
Very much in the news, artificial intelligence and machine learning. We will hear more about the use of AI and ML in the financial sector tomorrow. But today we would like to conclude the first part of this year's BIS Innovation Summit by focusing on the ethical risks presented by those technologies. So please join me in welcoming our speakers.
Brilliant. Well, thank you so much for all being here today, and really excited to be discussing this panel on a topic which I don't know about anybody else here, but my Twitter feed is entirely dominated by the questions whether ChatGPT-4 is the future of AGI and whether we need to be concerned about superintelligences eating us the next few years. But, just to focus on the financial sector side of things, at a time like this, obviously, we're seeing some really fascinating discussions about fintech, and I think we'll be hearing more about that in a session tomorrow, about potential good uses for fintech and the ways in which it can open up financial inclusion and more rapidly and readily access markets to people who have been traditionally excluded. Although on the flip side, there is the real questions around issues of bias and systemic flaws, which could lead to major problems for those same groups and further exploitation around issues of data. So I'm delighted to be joined by some excellent panelists today. We have Anna Fellander, who is one of Sweden's leading experts on digitization, and she's the CEO and founder of Ank.ai, which works with companies around assessing the ethical risks of their AI systems. And Nikita Agarwal, who's a postdoctoral fellow and a lecturer at UCLA, where her areas of focus include consumer law, international economic law, and financial regulation, and she's previously worked at the IMF as well. So, Nikita, if we could start with you, given all the buzz and focus on AI, both the positive and negative around financial services, I'd be really interested to get your thoughts around some of your current research, which is looking at the idea that algorithms such as AI and machine learning are not ethically neutral. I think there's an idea often that tools or digital tools are much like any other tool. They just exist and they don't have a motive purpose. But I'd be really interested to get your thoughts on some of the major problems in financial services posed by these systems.
Yeah, thank you. So I think there's a sort of threshold question that we need to address before we can have any meaningful conversation about the ethics of AI or the ethics of machine learning. And that's really the question of, what is the measuring rod, right? Or rods. What are the values that we are concerned about? What is our normative framework? And so is it about some notion of efficiency? Is it about some notion of fairness? And if it's fairness, is it some kind of procedural fairness, some kind of distributional fairness? Are we concerned about certain rights like privacy and what we mean by that? And more often than not, we're balancing many of these objectives, right? So we need to be cognizant of the need to navigate conflicts between them. They're not always going to be aligned. So that all being said, my own lens is particularly focused on questions of distribution and specifically understood as poverty and inequality of income and wealth. And so through that lens specifically, I'm concerned about the potential regressive effects of more machine learning driven decision making, for example, in credit markets, to the extent that it could result in increased price discrimination, less affordable borrowing by lower income, higher risk groups, and the inverse for higher income, lower risk groups, which could have regressive effects. And these regressive outcomes could sort of travel through multiple channels, and it could be due to, for example, the fact that you have more personalized products, you have more personalized pricing, it becomes harder for consumers to comparison shop. In these digital environments, it's much easier to sort of consumer, so to speak, and prevent them from searching and switching. And so you essentially, even if you have a market with many sellers, you have no real effective competition. And these kinds of effects are exacerbated when you have these very large companies like Google and Apple that are taking up more space. From another perspective, there's also, to sort of offer another angle on this, we have major kind of push, or we've seen a lot of developments in sort of pre-trained models, right? So sort of off the shelf, or like these machine learning libraries. We have to ask ourselves, who's training these models? Who's labeling the data? And is this being done in low rights jurisdictions where there are no protections for workers, or very limited ones, and so sort of what people refer to as ethics dumping. And so these are just a few sort of concerns from a largely inequality-focused perspective. But as I say, where I started, how we evaluate the ethical risks of machine learning in financial services really depends on what framework you want to apply to begin with.
Brilliant. Thank you, Nikita. Anna, just from your perspective, working with companies who are looking at ethical risks in their AI systems, what are the kind of areas that you see emerging in the financial sector? And how does that affect the business of firms? I'm just thinking sort of parallels maybe to cybersecurity, which maybe 30 years ago was not really considered a focus in any way for firms, but now is obviously core.
Right. So first of all, I'm glad you mentioned in the beginning that AI is actually should be embraced by financial actors due to staying relevant, but also increased efficiency. But 85% of all AI projects are leading to misguided results due to bias in data, algorithms, and the teams responsible for managing them. And this poses costly, unintended, and ungoverned risks such as privacy intrusion, discrimination, lost autonomy. We have a human right for autonomous decisions, disinformation, you mentioned ChatGPT, and social exclusion. And in the financial sector, we see AI being implemented without an ethical lens on, for example, credit scoring, leading to discrimination. We've seen females with the exact same financial situation being rejected credit, whilst a male being accepted due to historical bias. And also in the insurance industry, risk prediction. I mean, this is also the question of how much data is decided that I want to share, and how much data I'm in a conscious and autonomous way choosing to be shared by these actors, and also how this can discriminate low-income areas and people. And then we have AI for recommendations and upselling, nudging. So there's like a tipping point where it's a good tailored service, and then it's not so good because the consumer, the financial customer is getting into manipulation and maybe over-consuming credit, for example. And also we mentioned ChatGPT. So the question is, why does this happen? Because all of this is happening unintentionally. So first of all, there's algorithms are working off historical data, norms, and also there's no go-to-market readiness threshold. There's no way of saying this is a sufficient data set, this is trained, and it's validated. And also, there is the bias of the creator. So, Nikita, you also mentioned that the coder, first of all, the coder, he or she, needs to translate the ethical principle of a bank into code. And how do you do that without training? And also, how does this scale in a broader ethical and social context? And if I, as a coder, of course, wants to maximize engagement, profits, and sales, how do I let ethical guardrails get in between? And can I actually make those decisions by myself? So now to your questions, critical business decisions are taken in tech silos without aligning them or translating them to regulation, nor the context where the solution or service is used in. So we talk about cashless societies. I hope Sweden will be the first, but there will be cashierless stores. And in these cashierless stores, everything is optimizing towards customer efficiency. Like, I want to be smooth, I don't want my devices. But when is it so efficient that I lose my autonomy and I don't know if it's debit or credit. So we need to demystify the tech silos and also put the ethical questions on the top of the agenda, make the consideration between fairness and precision, between tailored services and privacy intrusion, and between the maximizing engagement sales towards your organizations or financial institutions' ethical principles. And this is human rights, actually, that are being violated.
You remind me, actually, my friend, who I won't name, but who's also an AI ethicist, refused to go into I think it was Amazon Go store on the grounds that they didn't want their data taken, and it felt, so I think it is coming, those concerns. But what you're saying does lead on sort of neatly to the kind of follow-up, which is sort of the ways to mitigate some of these risks. I think you've touched on sort of that nature of the silo being quite a problem in terms of AI being developed by small teams and not necessarily having the business side or the legal expertise at the off. And I was just curious, from your perspective, other ways to kind of mitigate these concerns and, I suppose, how are firms deriving value from protecting or ensuring that ethical AI systems are put into place?
Right, so you need to detect early, because it's costly to have AI investment being withdrawn. And it's also, this is not the time to fail fast. I'm not going to say who said that, but because if you fail fast, you will have massive reputational risks. And trust is key, right, in the financial sector. And also the upcoming regulation, the AI Act and the AI Liability Directive will pose financial sector sanctions. It's up to 6%. But anyway, so how we work with organizations is to work on the 4 requirements for responsible and ethical AI. It's explainability, and that's not explainability in the tech silo way of governing that, because if you use a product like Lime, an explainability model for AI, the result of that cannot be understood or translated into discrimination law, for example. So, and then there's transparency and there's accountability. You mentioned cybersecurity. This is exactly the same. This dark cloud of fear that cybersecurity was 20 years ago. Same with ethical AI, but now we see that organizations are appointing chief ethical compliance officers. But the most important thing is governance. How you dismantle the tech silo and you have cross-functions governance between the tech silo, the compliance and legal teams, and the business team. And so being where the solution is used, having the end customers harm in a risk assessment, impact assessment way of measuring it, that's what the AI Act is all about. So the AI Act could be seen like a triangle, and the upper, which is prohibited, is going to be sanctioned by 6%. But the financial industry is in the high-risk AI. And all high-risk AI needs to be, or there needs to be a human in the loop in all AI development stages. You need heavily reporting on explainability for non-tech decision makers, on accountability, and also the impact assessment. So what's important here, and the gap, is how do you take AI governance and marry that with ISO risk management standards, that is for the AI Act. And that's what I do with companies. I marry these two so they can understand each other. So the tech team can report to non-tech stakeholders and to regulatory bodies.
And Nikita, sort of following up on the AI Act point, I'd be interested to get your thoughts both on sort of the balance between kind of where public regulatory action is needed and private market initiatives can sort of fill that gap, but also actually just on the governance point. I know in the past we've had just more generally in tech companies bringing in AI ethics panels, and which have had limited or mixed results, to put it politely. And I'd be interested just as well on that front, sort of where you see that emerging, and in terms of chief ethical officers, whether that's to be treated as sort of, I'm sure some companies will treat it probably as window dressing, but obviously if you've got the AI Act and concerns about fines, how financial services companies will sort of need to engage with that more readily.
Sure. Yeah, so on the question of the balance between the public and the private, of course, this is the enduring question. And if I had the answer, I would retire tomorrow. I think there's no doubt that there's a role for government and regulation to play to the extent that unrestrained markets are not going to achieve the goals, particularly these sort of non-efficiency goals, if you want to call them that, that we are trying to achieve, or at least not in a timescale that matters. So government does have a role to play. Public regulation has got a role to play. And I think, there's many things you can do at the level of the technology, but a lot of it is really just the sort of traditional prudential and consumer protection regulations that haven't really been designed specifically with technology in mind, but ultimately what we're concerned with is the outcomes of the technology, right? And in many ways and this is sort of a principle that cuts across many different sectors, it's not that prudent to regulate the technology itself just because there's a risk of obsolescence and so on. And so, for example, when I talked about credit markets, we need to have robust ability to pay or affordability testing, which are more developed in some countries than in others. Of course, there's a role for market solutions. I think open banking, to the extent that it is partly market-driven, is useful. I think it's useful to empower consumers to manage their own data, but I do think there are real limits to that as a mechanism, limits to private ordering for various reasons that consumers will not be able to self-manage their personal data and the outcomes due to their personal data. And so we do need to have public frameworks in place. And so relatedly, the ethics panels you talked about, and yes, there's been a trend in recent years to put in place ethics advisory boards or ethics advisory committees, appoint chief ethics officers. Call me cynical, but I don't know that the incentives are that well aligned for firms, at least those with profit maximizing motives, to do this for reasons that are not aligned with that motive. I think Apple's move to do things like do not ask app not to track, and this sort of thing is more of a pretext than anything else. I don't think that it's really serving privacy per se as so much as the ability to control more consumers in their ecosystem. So it potentially is anti-competitive rather than harmful to consumer welfare rather than supportive. The other thing I wanted to say is that yes, there's a role for government, and we are all sort of conversant in financial regulation, financial policy, but it doesn't stop with financial policy. There's also a limit to what financial policy or even monetary policy can do. There's an important need for investment in skills and in labor laws that will protect workers and ensure that workers can share commensurately in the returns to innovation, right? So there's a lot that financial policy can do and monetary policy can do, but there's also other areas of policy, public policy, that are as essential.
Before I open up, Anna, do you have anything else to add? So you're scribbling notes. So
I have so much to say, but you're the guide here. So.
Well, well, I mean, before I open up, yeah.
Well, first, I think what Margrethe Verstaegen said when she announced the proposal on the AI Act is that EU citizens we're not going to be competing with EU citizens being human rights being violated. So it's actually it's an awakening by this act what is actually being when we look into the black box that is now becoming a glass box in glass organizations, because that's the new thing. Like an ESG governance form is transparency, and this is the S and the G. I truly believe that even though there are critics saying that this law will hamper innovation, productivity, and disproportionately hamper the growth of SMEs, I think we should ask ourselves, what's the alternative? Because that would be a distrust to institutions and society using ungoverned AI. And then I also wanted to discuss the actually going beyond compliance and making it your competitive edge. So US companies, they have standards, they don't go with regulation, but then they need to comply with EU regulations when they're active here. So this regulation will in fact awaken citizens, and I believe it's not the responsibility of the clients or the citizens to have they're put in an asymmetric relationship here, because you can't grasp how, when I opt in to different, I give my consent in different data sources, I cannot know how AI can create insights that is privacy intrusive for me. So the technology is so complicated at the moment that the consumer or the citizen can't have the responsibility of actually interpreting it. So organizations should be, and I truly believe that regulation is the right way to go about it.
Ian, thank you. On that note, can I open it to the floor if there are any questions of the audience? Somebody ever? Yeah. No, quite a few questions from the audience.
Thank you very much. Jeff Goodell, University College London. So we know that the tech world is not some force of nature. The tech world is us. We can decide what we want it to be. And here we see a problem that is not mainly about what the AI algorithms are doing per se, but about the data to which the algorithms have access. This is particularly important in the context of payments, because engaging with the economy, which has become the digital economy, is an intrinsic feature of modern life. This came up earlier in the context of privacy and anonymity. Now, acknowledging that people cannot verify what data is not being used to do, and that they cannot trust what they cannot verify, then is the business opportunity intrinsic to data analysis incompatible with the ability for individuals to avoid sharing more than they want to share when they conduct financial transactions?
For me, okay. So I think we need to distinguish different meanings of privacy, and I think embedded in your question are various notions of privacy. So is privacy just obfuscation, so that we just do not use information, and the fact that someone's information is being used or someone's being watched is an intrusion on their privacy, right? Another interpretation, another meaning of privacy could be that the individual has the ability to control what happens to their privacy. So it's not about obfuscation in this sort of classical idea of a private sphere, but more that you get to shape what happens with your identity, your information. Or is it actually something more than that? So we're not talking about these ideas, sort of what would be considered more sort of maybe rights-based notions of privacy, but a more kind of consequential idea that it's not so much even that the individual needs to control their data or, protect their data, but we just need to mitigate any harms due to the use of that data. In that case, the duty really falls on the data processors and the data controllers to use the data in the best interests of the individual. And so I think, whether we think that this the machine learning and basically a data-driven financial system is incompatible with privacy, it really depends on which of those notions of privacy you conform to.
Hannah, you?
So data bias, so I want to underline, because there's no black box algorithm or AI solutions that will be on the market when we have the AI Act. So I just want to underline the biggie of the AI Act. So you will have to report. There will be a human in the loop in all stages of AI development. You will have to report what data says. You would have a customer saying, "Hey, I have the experience of being harmed. I'm being discriminated. Please explain what data the algorithm, what was the data set that decided what decisions the algorithm should take the decision on? So I'm just saying that times are over when we can work with deep learning in the way that there was no explainability, no interpretability, and no accountability. So, that's why I want to just talk about the AI Act, how this will just shake the environment and the awareness of the customers, but also how organizations needs to demystify the tech silo and do the impact assessment together with the coders. And that also leads us to what kinds of skill sets do we need in the tech team. And the more AI we implement, the more we need the female energy I'm not saying that female are more intuitive, but there's an empathy and there's a social skill set. So it could be, and that is like it's being polarized. The more we implement AI, and the left side of brain can rest, and we can activate the right side brain, which needs a more female. And you talked about education and how to get more diverse tech teams. So that would be a natural effect on this.
Thank you.
Thank you. Simon Gleeson from Clifford Chance. In order to regulate something, you first have to define it. And the biggest failure of the draft AI proposal is its complete inability to define what is meant by the term AI.
Yeah.
Now, if you've ever renewed your car insurance online, you have had the experience of entering into a contract with a computer involving no human being. Is that AI?
Yeah.
And if not, how do we define AI? What is it you're trying to regulate?
Yeah, so the critics on the AI Act has been on how vast AI is defined. So it's from rule-based applications, which is, if this happens, do that. I mean, that's super easy statistical models, right? All the way to deep learning, which means that all organizations need to answer the question, do I have AI? And if I do, is this high-risk AI? I mean, if it's prohibited, but every organization needs to say, okay, do I have high-risk AI? And if I have low-risk AI or medium, that's like a chatbot. The zone between the high-risk AI that needs massively reporting and a new governance system, and between the medium to low risk, like a chatbot, that is, it's great, but it can also be that a chatbot, you've heard the chatbot that became a racist. So this is, all organizations needs to detect, where do I have rule-based applications, and report.
Do you want to anything further to add?
I mean, I think, Simon, that's a very good point, of course. It's not defined, essentially, right? It's just everything, computing, we don't really know. It speaks a little bit to the need for technical expertise in government and those who are involved in drafting these things. Yeah, I mean, I think it also forces us to sort of think a bit more critically about the conversation around ethics of AI. And if I can suggest that there is a strong political economy dimension to the EU's I wouldn't say that they're rushing, but they are slightly trying to race ahead to regulate AI, and there's a sort of strategic goal to be the first to regulate this and to potentially capture a market. It's possible that in the haste to regulate, or in the race to regulate AI, we're sort of rushing over some essential key parts. Yeah.
I love this panel because we're not aligned. This is exactly how a panel should be.
Excellent. I think we're... No, sorry. It is nice not to have... I was going to make some AI alignment joke, and then it just missed me. So apologies to everyone watching. I was going to say, we're just about to come up to time, and I want to just kind of to wrap up and say thank you both and say it's been a fascinating panel, and I think for me, certainly the points which both the speakers made up brought up on the definitional aspect really is something which, having not been in tech journalism for a while proper, is something I'll go back to and spend the next day looking through the AI Act in detail. So huge thanks to Nikita and Anna and to the BIS for this event. Thank you.